tag. Reuters reporting the model will cost at least €500,000, and that's without any of the special features. Ferrari CEO Benedetto Vigna confident that the car will sell just as well as its combustion engine models. The model expected to be unveiled in the fourth quarter of next year. Joining us now is Bloomberg's Oliver Crook. He's already put his order in. Ollie, talk to us about the significance of this pricing point coming through Ferrari and what it means more broadly in terms of the EV market, Ollie.
Yeah, Tom, this is really interesting. And as you say, what's the point of having a Ferrari if you don't have any of the upgrades or the customization? So for €500,000, that's the starting price for this car. The first EV Ferrari has ever put out. And if you get those upgrades, that tends to tack another sort of 20% onto that. So this is a sort of really interesting figure because that compares with the average sale price of their cars, you know, in the first quarter of this year, which is closer to €350,000, right? So that is quite a bit more expensive. So there's a lot of unknown going into sort of pricing these kind of cars. Because as you know, it's not this super liquid market like the rest of the auto sector. They're also apparently developing a second model, which was also something that we've been watching out for. And again, still in the early stages of planning this. But yeah, as you say, this is going to be unveiled in the fourth quarter of next year. You know, really very interesting. And of course, the inevitable tide of the auto market going towards EVs, but a lot of unknowns.
And you focused a lot, and you've done a lot of reporting around the tariffs, around the potential spat, or at least we see that evolving between the EU and China. And that question, how would that potentially impact Ferrari? How much of an important market is China? How do you see that story evolving?
Yeah, it's always a very important market. It's obviously a huge market, as you know, Tom, for the auto sector. But what I think is really interesting is with these EV tariffs and all the unknowns about kind of where the trade barriers are going to be, all of these automakers are looking at their manufacturing footprints, where they're going to actually produce these cars. And it's super, super important for the luxury and super high-end market because it doesn't make sense to build those cars in lots of places. It makes sense to build them in one place and ship them to other places. And already you have an immense price point. If you're going to see another 10, 15, 20, 30% tariffs on those, that's going to have a huge sort of impact. We know already that Ferrari is going to build a new sort of hybrid factory in Italy for June. So the stakes are very high here for the very high end of these cars. You know, for example, Mercedes-Benz, you know, they build their Maybachs, all of the ones that go all around the world. Those are built in Stuttgart. You throw a tariff on that, that can have a real impact.
Okay, Oliver Crook, thank you very much indeed on the context of this price point coming through. Reportedly for Ferrari, €500,000 without the accessories. Okay, let's switch focus now to Wall Street, where Bloomberg's Shonali Basak spoke exclusively with Citi's CFO, Mark Mason, about transformations of that bank. Take a listen.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, all right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business and our security services business.
It's interesting because, to your point, even though security services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup's stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup's stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%. And we talked about the services businesses being a significant contributor to that, both in the top line and our services businesses at 20% return on tangible common equity. In the wealth space, we brought in new management there. And we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure to increasing the banker productivity to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
Citi CFO Mark Mason speaking to Bloomberg's Shonali Basak. Staying on Wall Street, JP Morgan joining Goldman Sachs and scrapping the cap on London banker bonuses. This is something, of course, that the government here in the UK pushed through. Goldman Sachs went ahead with it. They got rid of the cap. JP Morgan joining Goldman. And so now the ratio in terms of the bonus ratio is moving from 2 to 1 on terms of base salary versus the bonus to up to 10 to 1. So a significant boost in terms of the potential bonus that JP Morgan's staff here in London could be taking home at the end of this year. Let's check in on these markets. Then a challenge day for European stocks. The benchmark is currently flat. It's a bit more interesting when you lift the hood. You look at the FTSE 100 getting a lift in terms of what's happening on the commodities front. Basic resources is one of the leading sectors, is the top sector so far. So the UK, the FTSE 100 getting a gain of 0.2%. The French CAC 40, though, taking a knock down 26 points. On an individual stock basis, you got top of the list is Games Workshop after an upgrade there. But some of the chip makers in Europe are losing some of the pace that's come through. Currently down between 3% or so for ST Micro and Infineon. US futures, though, pointing to gains of 0.1% when the US comes back, of course, on a Thursday. Ben Laidler of eToro is coming up next. We'll get his views on how to position in this market. Stay with us. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us. European headquarters in London. I'm Guy Johnson. Welcome to Bloomberg Markets. It is Juneteenth, of course. US markets are closed. However, there are things happening in the rest of the world that are probably worth paying attention to. So let's check in on the markets, then we're going to talk about the markets. We're going to figure out how politics is impacting what we're seeing on the screens, and also what's going on with NVIDIA and the impact that it's having right now. But let's start with the market check. Let's figure out what's going on. This is what the story looks like in Europe. Stocks going nowhere in a hurry, I have to say. Equities are largely becalmed. There's no volume. The US is out. That's the kind of picture, as you can see, top of the screen there. US futures as well, fairly flat, though obviously yesterday the story was driven by NVIDIA. Does that carry on tomorrow? In terms of the narrative elsewhere, the pound surprisingly catching a little bit of a bid today. This despite actually inflation coming back down to the Bank of England's target. The Bank of England is going to be meeting tomorrow. Do not expect any fireworks. The British election is getting in the way. We'll have to wait probably until August or September. And then you got France. We're going to talk a lot about France over the next hour. Let me assure you of that. So that's what the markets look like. We're going to talk more about them in just a moment. So there's a couple of things that are really dominating right now, one of which is politics. Here in Europe, we're talking a great deal about what is happening, obviously, with France. We probably shouldn't ignore what is happening in the UK. This, although, feels like a bit of a prelude, though, to the build-up to the November election over in the United States. So that's kind of one subject, which is in some ways nice to have, because it means we don't have to spend quite so much time talking about the Fed. The other subject that obviously is dominating the agenda right now is NVIDIA, and why that stock keeps doing what it's doing, i.e. climbing higher and higher and higher, and now becoming the largest market cap in the world. So we'll talk about that in just a moment, but I want to kick off and talk a little bit about politics, and we're going to start there with Bloomberg's Michael Masika and John Stepek. John, I'm going to start with you. Has the moron tax, which the UK has paid since Liz Truss, finally been given to our Gallic cousins across the English Channel in France?
I think that's very fair to say, yes. I think they've inherited our mantle. I mean, the one thing I would say, to be fair, I think the UK was already getting to a point where it had redeemed itself to an extent. Markets seem to have, given us more leeway over the last 3 or 4 months. The FTSE 100, for example, has been one of the better performers in global markets, excluding NVIDIA, obviously.
Yeah.
But I think that this is kind of the coup de grace, if you'll forgive my French. And we've now passed over. All the political turmoil is now in that part of the world as opposed to here, where it's looking, to be honest, kind of boring for once.
We'll take boring for a while. Not boring over in France. How long does this last for? If this political story around France continues to cause turbulence, do we see what we've seen in the UK, i.e. a long period of underperformance, Michael?
Well, Guy, this is a slightly different setup. The big difference when we came into those French snap election announcements, surprise election announcement, was that investors were heavily positioned on France and on Europe generally. But France was like a big overweight everywhere, which is not the case of the UK, which has been like an underweight, like globally for a while now.
Yeah, but that was we suffered because of Liz Truss. That underweight was there because of the stock mix and also the fact that people didn't understand the politics and the stability. Is that now France's problem?
The mechanism is like, obviously, people have started to reduce their exposure. So, but they still need to keep their exposure, generally speaking. So we've seen a switch to the UK. You were talking about it, John, just before. Like there's a switch from like what is risky, what is less risky. At the moment, the UK looks pretty dull, as you were saying, in terms of election first, but also in terms of exposure. Like if you take the FTSE 100, it's like global exposure, lots of pharma, miners, oil. It's kind of like a bit defensive at the minute compared to the rest.
Yeah.
So you have a switch that is being operated at the moment.
What's the contrarian trade?
Well, the contrarian...
And are we starting to see that?
Yes. So we're starting to see that. Why? Because the dislocation that we've been seeing, especially in terms of volatility in Europe versus the US, or in France versus the rest of Europe, like France versus like CAC versus DAX, for example, is like kind of exceptional. So we're having like a very unusual dislocation in all those data. So obviously you have fast money like stepping in. Hedge funds have started to buy into French equities this week. I mean, JP Morgan was saying that earlier, the trading desk at JP Morgan was explaining that they were starting to buy that. They're still hedging their exposure through futures mainly, but they're stepping in. And hedge funds were actually not really well exposed to France and to European equities going into there. So it's kind of like the entry point moment.
Nice,
you know?
yeah, much better entry point than previously existed.
Exactly.
John, in terms of therefore what happens with the UK next, the UK market, inflation's coming down, politics is going to get boring, Bank of England's probably going to cut rates a couple of times. Does the trade that has already started continue to gather momentum as we suck in maybe extra resources from the continent as well, extra fund flows from the continent as well?
I mean, you would hope so. I mean, one point to make is that, I mean, retail outflows from the UK have been 3 consecutive years of just relentless outflows. You've got to the point where it's kind of like, well, is there anyone left from our domestic kind of capital base that's not sold? So I think there was an element of that already happening, but we are coming from a very low base. UK stocks are still relatively cheap. Yeah. The kind of we haven't yet seen kind of monthly inflows. I don't know if you pay much attention to the Bank of America Global Fund Manager Sentiment Survey.
Do regularly.
Yeah, I think that's a really good one, and you can see the UK is gradually coming off the bottom as the most detested market in the world to slightly less detested. Yeah. And that's a good sign for, you can worry whenever it gets to the top. Whenever people are saying you must buy the UK, that's when you should be thinking about getting out again. But I think we're a long, long way from that yet. Okay, well, let's do some compare and contrast if we can. Do you want a barbell there for the UK and Nvidia? Is that the ultimate portfolio now? I think that's a great portfolio. You've got your rampant growth on one side, and you've got your kind of deep value on the other. And also, I mean, in sterling as well, sterling is still relatively inexpensive compared to its history. And obviously, you've got to split pre-Brexit and post-Brexit from that. But you get a relatively cheap currency, relatively cheap market compared to. And Nvidia is basically, well, what happens if all economic kind of reality has been and fundamentals have been suspended forever, and it just keeps going up for good. So yeah, I think that's a good trade. That'll be that's the way to go. I was talking to Max Kettner at HSBC like a little bit earlier on, and he was saying, yeah, you look at Nvidia, and then you think about what else is going on. We were all told that the Chinese real estate trade was going to come back. That ain't happening. We were told that Europe was going to be the trade you wanted to diversify out of the United States. That ain't happening either because of what is happening in France and elsewhere. We were told that the market was going to broaden out in the States. And that certainly ain't happening. Look at what's happening with small caps. And then you look at the S&P, and most of it's down this year, but tech is up, and kind of Nvidia's right at the top of that. And basically, you either buy because you love the AI trade or because you just hate everything else. Which one is that the narrative around Nvidia? And which one of those two things do you think is actually the dominant force?
There's a bit of that. This is the pure play. This is the pure play. I mean, there isn't any other pure play on AI. We're talking close to 90% market share in some of the GPUs. You want exposure? This is the only way, the only pure way. So a lot of people are talking about enablers, AI enablers that will benefit from the growth in the AI market. But that will take a bit of time. Some people don't want to waste time. The other thing that I've been hearing lately quite a lot is since the split, there is a huge appetite from the retail market as well. Because when Nvidia was trading, oh yes, it did, definitely. I mean, I was looking at the options volumes just this morning, and actually the options volume has been going down compared to the past quarter. So there's less of a push from the gamma trade that has been powered the stock earlier this year. So this latest push is really looking like a retail.
So this isn't single zero-day options.
No,
that are powering this.
No.
Do you think the retail trade's got legs?
Well, I don't know if it goes legs.
Because the effects usually of a split is you get the effects and then it fades.
At the moment, it looks still strong, and also you were saying we were discussing it earlier. The exposure. If you want exposure to pure AI play, this is the one that's out.
certainly seems to be proving it, now the world's most valuable company. Guys, thank you very much indeed. Michael Basica, John Steppe, setting us up beautifully for what's going on in these markets. Let's carry on the conversation. Ben Laidler, eToro Global Market Strategist. Ben, let's start with NVIDIA. Why do I buy NVIDIA? What's the logic? And do you think that logic persists? We've just run through some of the reasons. Some of it could be gamma hedging. Some of it could be the pure play AI story. Some of it could be the stock split hangover effect. What do you think the logic is right now?
The logic is that they dominate the AI market. It's moved decisively from hype to reality. I have never seen a company of this size grow top-line revenues 260%. That sort of run rate more than justifies this 40 times price-earnings ratio that you're having. So I don't find it difficult at all to justify, NVIDIA today. That doesn't mean you should be chasing it. That doesn't mean you shouldn't be looking to diversify sort of elsewhere. But this is a very fundamentally driven rally. I don't think there's much hype out there right now.
When a country builds the world's tallest building, it usually preludes disaster. Is that what we're seeing? Is there? Can I make that case maybe for NVIDIA, the world's tallest company?
Well, in the very long term, yeah, you're absolutely right. I mean, there have only been 12 largest market cap stocks in the S&P 500 in the last century. So this is rarefied air. And when you look back at the list of those 12, there are some names in there that you'd probably like to forget if you'd held them in your portfolio all the way through. General Electric, GM, Cisco, DuPont, IBM, AT&T, Philip Morris. A lot of those have seen better days. So yes, time is not on NVIDIA's side. Growth will slow. Competition will sort of catch up. But as an investor, the key question is, is this happening in 5 years or is this happening in 5 weeks or 5 months?
What happens on the day, though, that, let's say, paint a picture. What happens on the day that expectations are so high and NVIDIA's still cracking on and doing great business, but it doesn't meet gross margin expectations? Expectations are so high. We're just talking to Michael Basica about what happens with the options story. Like at the moment, there's this kind of, there is, despite kind of maybe fading a little bit, still this kind of self-reinforcing trade where it just keeps going up. You buy it on the day, there's a gamma trade that's associated with that, the stock keeps going higher and higher and higher. It's going vertical and it's huge. And I'm just wondering, kind of, as we get more and more concentrated, what happens on that day when the margin miss comes through? Does all of that go into reverse?
Yeah, it's going to be horrible, right? Because we've had, 4 or 5 quarters of consecutive beat and raises. So by definition, that's going to end at some point. And the bigger NVIDIA is and the more passive flows that there are, the more painful that's going to be. Which is why I think the biggest trade in markets right now, however much you like AI and big tech, and it's been the juggernaut, is you need to diversify into everything else. Whether that's Europe, whether that's emerging markets.
Yeah, okay. I hear that. So, Ben, I hear that a lot, and I can understand the logic. The problem is that you are paying an NVIDIA tax if you do that. Because diversified portfolios are underperforming quite significantly. They're not just underperforming NVIDIA, they're underperforming big tech. So am I prepared to take a lower rate of return in order to protect myself? Because the diversified portfolio is not going to deliver, is not going to outperform. So do I just have to accept a 6-7% rate of return, which is what diversified is delivering right now, rather than the multiples of that I'm seeing on big tech?
Yeah, except that I don't think this big tech performance is, repeatable. NVIDIA is already the biggest stock in the world with a 3.3 trillion valuation. Is it going to double again? Right? Do we really think this is going to be a $6.5 trillion, dollar stock? I doubt it. So, whether you want to do the diversification quickly or slowly, I think, you should be doing it because the rest of the world has catalysts, and those catalysts are here and now. The global interest rate cycle is picking up. These economies are firming. And as you referenced in your previous piece, these markets are very cheap. They're very underowned. And crucially, the US is 65% of global market cap right now. It's been a giant sort of sucking sound of outperformance and flows. That doesn't need to reverse by much. You don't need a little bit of that money going into these other parts of the world, which have become very small and very cheap. A little bit of good news, a little bit of inflows goes a very long way in these other parts of the world. And I think that's where you should be looking.
The problem is, though, you get to the end of the month and you get the tap on the shoulder, and it's like your portfolio's done this and that portfolio's done that. It's a really tough trade to ignore this. And I'm wondering, Cameron Kreis has written about this as well on the Bloomberg terminal. Like, do we need to see more people being sucked into the kind of the tech bubble before it bursts? Like, how much is there enough money in that trade already to justify some of it coming out again, or is there still potential for more to go into it before that happens?
I don't think it's a bubble. As I say earlier, I think this is very fundamentally supported. You made the comparison with, .com. Cisco's valuation, which was the Nvidia of its day, peaked at 110 times. Nvidia's less than half that.
Yep.
And as I say, growing revenues 250%. So I think this is quite fundamental. But I do think the rest of the world has catalysts, and those catalysts are happening right now. The ECB has just cut interest rates. The UK is going to cut interest rates over the summer. These are much more interest rate sensitive economies, stock markets than the US ever is. So how quickly do you do that diversification? Yep. I don't know. But, there is a story in the rest of the world. There are catalysts. And as I say, a little bit of good news. You don't need good news when you're this depressed. You just need a little bit of less bad news. So I think the risk reward also makes, a lot of sense.
Yeah, we don't do glass half full very well over here, though. Ben, great to catch up. Thank you very much indeed. Always such a pleasure. Ben Laidler joining us from eToro. OK, we're going to talk about some of those catalysts in just a moment. We're going to talk about France, the country facing blowback from the EU for breaking deficit and debt rules. It's perfect timing, you could argue, on Brussels' front. We'll have more on that story next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Or other authorities.
Could face bigger challenges next.
Was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Wednesday, the 19th of June, Juneteenth, the US is on holiday. European markets becalmed as a result of the lack of volume. Welcome to the show. I'm Guy Johnson in London. Let's talk about French politics. The EU is set to warn France over breaking deficit and debt rules, triggering a process that could lead to fines, could complicate, obviously, campaigns in the countries. We've got a first round of elections 2 weeks away. Let's talk about this. Caroline Conan joins us from Paris. Caroline, I want to talk to you about the lessons that the French may have taken away from the UK. When Liz Truss came into power and she cut taxes and she tried to put the UK on a growth agenda, the market didn't like it. And we're already seeing significant turbulence around French markets, around equity markets, around debt markets as a result of what we're seeing. To what extent are French politicians afraid of the market? To what extent is Marine Le Pen afraid of how the market will treat France if she doesn't tread carefully?
It's actually quite interesting because the current finance minister, Bruno Le Maire, actually warned about this possible least trust moment for France if the French elect the majority with the National Rally on July 7. So already he's warned about a potential debt crisis. But what we're seeing today with France being included in this EU deficit and debt procedures for excessive deficit and debt clearly is great for Marine Le Pen in a sense that she's going to seize this opportunity to be able to attack Emmanuel Macron on the fact that he's been handling the public finances of the country for the past 7 years. And look where we are. We have the French deficit at 5.5% of GDP, above the EU target. French debt is at 110% of GDP, much higher than the 60% EU target. And already remember last month when France was downgraded by S&P, Marine Le Pen was very quick at attacking Macron, making him responsible, saying, you have ruined France. So we'll see the reaction from the leaders of the National Rally today, but clearly she is also worried about the reaction of the markets and trying to convince them that there's not going to be any least trust moment if they get a majority in the parliament.
So what is the focus on right now? If they're trying to convince the markets of that, what else are they focusing on? What are the big stories that are dominating the political agenda today?
Couple things. So a couple hours ago, Jordan Bardella, who will become prime minister if they get a majority in parliament, was at the Eurosatory military forum north of Paris, and he said, we're not going to send troops, French troops, to Ukraine, kind of echoing what Macron had said a few months ago about this possibility of sending troops as last resort if France was in threat. So Jordan Bardella obviously trying to reassure on the defense front. Of course, it's hard. It's a difficult position for them because remember in 2017, Marine Le Pen for her presidential campaign received a loan from a Russian bank, and even if she has tried more recently to distance herself from Vladimir Putin, people in France do remember that. So what Jordan Bardella and Marine Le Pen, both on the international front and on the spending front, are trying to do is to reassure, to appear reasonable, to appear mainstream, to get what they're trying to achieve, which is a majority on July 7.
Caroline, thanks for keeping us up to speed. We'll come back to you as we work our way towards this election on a regular basis. Caroline Conan joining us from Paris. Let's take one of the angles that Caroline was just raising there and develop it a little further. France and Italy, among 7 countries that are facing an EU infringement procedure for their excessive deficits. This is relating to last year. The timing obviously is inauspicious, you could argue, if you're Emmanuel Macron. Bloomberg's Craig Sterling joins us now to discuss. Craig, what does this actually mean?
Well, I suppose initially it doesn't really mean very much in the sense that this is going to be a long, drawn-out procedure. I mean, we're going to have, I think in September, the countries have to come back with a plan of what they're going to do about things, and then in November, the Commission's going to come up with its own views on that, and this is going to be a multi-year process. Romania has already been in the process over quite a period of time. But obviously, this is going to be an escalation, and these are, don't forget, these are new rules, or at least a sort of recalibration of the rules of the EU that are supposed to be stronger than last time. So it is feasible that we will end up in a full-blown showdown, especially if you have a confrontational government, let's say in France, for example, to take what you were just saying before, you know, between France and the Commission, with Brussels officials telling them, you know, to get their finances in order, and you know, the government in question maybe not necessarily wanting to do so. I mean, we'd have to see, obviously.
Other countries are on the list as well. How will Rome react to this? And why are other countries in Europe that face maybe some similar numbers not on the list? I'm curious as to the sort of selection process.
So there's 8 countries essentially, including Romania, that, as I say, has been on this for a while, and I think it is interesting to look at who they are. Obviously, France and Italy, then Belgium, which is particularly egregious. I mean, over 100% of GDP debt is one reason why you'd be on there. Spain isn't on there because its debt trajectory is falling. So I think that kind of tells you where we're going. What in general is the common denominator with them is high deficits, well above 3% GDP, which is the EU limit, and as I say, deficits that are not going in the right direction. So, or at least not in a timely manner, and that's what really worries Brussels. The fact of debt essentially continuing to rise and deficits, which would be putting that right if they could, not. In other words, staying well above 3%.
Yeah. Great stuff. Thanks for the update. Really appreciate it. Bloomberg's Craig Sterling joining us out of Frankfurt on that story. Still ahead, what do we need to talk about? UK CPI back at 2% target for the first time in 3 years, just in time for the general election. I'm not sure it's going to have much of an effect on that general election, but we'll debate that issue next. This is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
£8:30. Welcome back. June the 19th, Juneteenth over in the United States. US markets are closed. Futures are open, but US markets, cash markets, are closed today. As a result of which you're seeing fairly light volume over here on this side of the Atlantic. Equity markets are going nowhere in a hurry. That's the Stock 600 and US E-minis. They're doing absolutely nada right now. The pound, slightly surprisingly, you could argue, but it's fairly marginal, is catching a bit of a bid today. In fact, the dollar generally on the back foot throughout most of the FX crosses. And we continue to see French bonds on offer this morning, though the last couple of days they have caught a bit of a bid. Let's turn back to the UK story and focus on what is happening there. UK inflation has fallen back to the Bank of England's target for the first time in almost 3 years. Now, this, of course, supports the case for interest rate cuts later this year. CPI rose at 2%. That's the year-on-year number in May. That's down from 2.3 the month before. Critically, though, services inflation still fairly sticky. Anna Andrade from Bloomberg Economics standing next to me to discuss. Is that the takeaway from the data? Headline comes down, services still sticky, Bank of England, therefore reasonably cautious.
Yeah, I would say so. I mean, it's a bit of an awkward one because you have headline hitting the target and, you know, that's for the first time in 3 years.
Nice headline.
Headline, yeah. But then you look at it at services and it's actually proving very sticky. And it's not just this print itself. It's also in April when we had a lot of prices being updated and when we had the increase in the national minimum wage, you already saw some of that stickiness. And essentially what that tells you is that we're in an environment where firms are still a bit comfortable passing along the higher costs that they're facing. And that's not what the Bank of England wants to see. And so while the headline inflation came in a little bit above its forecast, so 0.1, services has a gap of 0.4 percentage points. And we know that the Bank of England is more tolerant about data surprises, but 0.4 is sort of, you know, a bit too hard to ignore. So
we've got a Bank of England meeting tomorrow, but that's a non-event because of the politics. So we're waiting to kind of see what happens in August and September. You've pushed out your forecast. Tell us about the change in kind of what you think is going to happen.
Yeah, so it was mostly as a response, well, to both the May CPI, but also the April CPI print. There's just some underlying stickiness. And we think there's a case for rate cuts to start in August. So June is not an option because of the election. As you said, August is the next likely timing that rates can start to be brought down. And we think there's enough reasons for it. So headline is at 2%. That kind of triggers this expectations channel that will bring down services in time. The economy, you know, took a hit. Labor market is cooling. So there's a case for rates to be brought down. But then it's more about the pace. So we were seeing a cut at every meeting, and now we're thinking only 2 cuts are likely this year because the BOE will sort of take its time.
That's going to have fiscal implications, isn't it?
That can, it can have fiscal implications. I mean, if you compare the spring budget earlier in the year, I think the rate curve that the OBR incorporated had 100 basis points of cuts worth in it. Now the current rate has 125 basis points fully priced in. I mean, it can reduce a bit the fiscal space, but there's a lot of moving parts. So, you know, it's only when we get to September that we'll have a clearer picture.
And we don't know when the first fiscal announcement from the Labour Party, were it to win the next general election, will likely be.
Rachel Reeves did point out that she would give the 10-week notice period to OBR. So that suggests to us that will be sort of late September. That's sort of mid-September to late September.
In terms of, therefore, kind of how we think the Bank of England is going, once we get kind of through the next meeting, what do you think the vote split's going to look like? What is happening on the MPC now in terms of how the various groupings, doves, kind of centrists and hawks, are going to be thinking? How do you think that is going to evolve?
Yeah, I think that's a very interesting question because tomorrow's meeting won't be very interesting, but there's one thing that will happen, which is it's the last meeting of Deputy Governor Ben Broadbent. Yep. And he has been sort of a driver of the center of gravity, a heavyweight on the thinking of the MPC. And he's sort of more, I think he tends to lean a bit more dovish. And he's going to be replaced with Claire Lombardelli. And so that injects a bit of a risk on whether, you know, I think if Broadbent had a departure, I would say a bit more confidently that we'll have for sure an August rate cut because I think that's where he's moving, where Bailey will move. But then, you know, Claire Lombardelli will inject a bit of uncertainty around that because she can be a bit more hawkish than him. Hugh Peel is also proving a bit more hawkish. So it's a bit uncertain whether you can actually get the majority. That's a risk.
One final quick question. I'm reading more and more pushback against active sales and just the cost of active sales. Do you think the Bank of England is going to be listening to that?
I don't think so. I mean, that has sort of dominated the news for a long time. One thing that I would say is that we have more active sales this year because they've decided to keep the envelope at 100 billion, and there's only 50 billion in sort of passive runoff, so in bonds maturing. When you look at next year, you'll actually have 80 billion of bonds running off passively automatically. So you'll only need actually 10 billion of active sales if the BOE is going to keep the 100 billion envelope. So that essentially means that there can be a reduction in active sales, just not as a reaction to sort of political pressure of news, but just sort of mechanically.
That's the way the maths work.
Yeah, exactly, mechanically. Yeah.
Anna, great to see you. Thanks very much indeed for stopping by to update us. We'll watch the Bank of England tomorrow. Not expecting a great deal of action. It is impacted by politics, of course, but we'll have some great coverage coming up. Anna Andrade joining us from Bloomberg Economics. Joining us now to continue the conversation as to what is happening with the macro picture, Salman Ahmed, Global Head of Strategic Asset Allocation at Fidelity International. Any views on the Bank of England? Let's just carry on the conversation. CPI is back to target. Should we be expecting a rate cut in August? Should we be looking at September? Do you think Anna's right that actually the pace of change is going to be maybe a little bit slower?
Actually, we are in the camp that I think the Bank of England will have to wait for the Fed to start cutting the cutting cycle.
When's that going to be?
Yeah, I mean, that's where obviously it's a complete coin toss, but it is an important factor for the Bank of England as well, because the services inflation is quite sticky. And then if you go in and start cutting without the Fed, into that cutting mode, then you expose yourself like the ECB did to a certain extent.
Do you think the ECB's made a mistake then?
I think now you saw the narratives, right, which came out of the stories, we have done it, but we don't know what are we going to do next. Yeah. So why do you do it in the first place? And what will 25 basis point do, on its own to change the shape of the economy? And then now we have a political risk, which has started to boil up as well. So, yes, it's outside their control, but you can see what is the problem with that one-off.
And let's talk about a couple of cuts, though, for the Bank of England this year. That's what's priced into the Fed as well. Are these symmetrical? Is the timing actually going to line up for the Bank of England?
So I think it's going to be tough, I believe, for the Bank of England to deliver those two cuts without the Fed going for those two cuts. I think this conditionality is important. And I think we can see that in market reactions as well. On US, data days, we have impact across the curves in Europe and in the UK, because the market knows that there are spillover effects. So I think they will struggle to deliver two cuts this year.
So everybody got the steepener. Everybody talks to me about the steepener. We're going to put the steepener on. It's going to work. At some point, it's going to work. At some point, it's going to work. At what point does the steepener therefore work? If the Fed is as cautious as you seem to be suggesting that it is.
So certainly, I think the cyclical factors, means that you need the cutting cycle to start for the steepener trade to really come on from a cyclical perspective. Yeah. But let's not forget that the structural fiscal profiles are not that that comfortable anymore. You have obviously political risk coming in Europe. You have elections in the US. Fiscal policy is going to be the front and center of those developments. And then at the same time, we have to start thinking about these balance sheet runoffs and how do they contribute to the pressure in the market. So yes, structurally, I think the steepener trade, I think, is starting to get interesting.
Okay, we'll wait and see when that actually happens. You talk about the political risk in Europe. How serious is the situation from a market's point of view for France, do you think, right now?
Look, there's a lot of differences compared to 2017. The rhetoric coming out is much different now. And I think there's a Liz Truss lesson here for everyone.
Do you think they're going to learn it, though? Do you think they're going to hear that lesson?
I think it's been close to, it's very recent. And you see how, the ripple effects can come through and cascading effects of the, political developments and leading to policy statements and then the market reacting to that. So I think the rhetoric is much different now. But yes, fiscal is going to be in focus. The market is pricing in those risk premiums. But we are not expecting anything like a full-blown sovereign crisis to come here. Firstly, ECB has a lot of tools now. To deal with that. They took years and quarters.
They come with conditionality, though. You really think the French are going to take conditionality from the ECB?
Look, obviously the political environment is very important, but it also depends on what is, what causes that conversation to take place. So I think there's obviously there are scenarios where the market forces those kind of discussions and tool deployment to take place, but those tools are there and the markets are aware of it.
France is trading 77, let's call it 78 bips over Germany right now. Could that blow out further? We got to 80 the other day, but I think that may have been on a shift in terms of the front month. Yeah. How far? What would be a spread but an OAT that would be concerning, do you think?
So if you remember, for Italy, the rule of thumb was 200 basis points.
Yeah.
For France, I would think this 120 would be concerning.
All right, so we're way away.
Yeah, we are a bit way from that. I think given the the different debt profiles, the fundamentals, I think beyond 120, this can become a convex issue.
Do you think? I'm just trying to see what the long-term average on it is in terms of the range on that. I think it's probably the one I got on my screen for the last. I can check the dates. It's kind of 43 to 50. Let's call the average. I need to find France. There we go. 50. Yeah, 50 is the average. Okay. Yeah. Going back. So, do you think France, as a result of what is happening right now, that average goes up? I.e., the longer-term premium that France has to suffer over Germany is something that is materially higher on a longer-term basis as a result of the turbulence we're seeing right now?
I would think so, because I think obviously you are looking at more political fracturing, and generally structurally there is pressure on governments to spend money on defense, on decarbonization. So I think generally you would see more relatively vulnerable countries who have higher debt to GDP ratios start to paying a little bit more in the market, and the market wants that premium, right, to protect themselves against those left tails which come from politics.
So what's the right trade in Europe right now?
So the trade in Europe right now is, I think we are expecting some little bit of a spillover to euro. We're not saying debt crisis type move. So we have gone underweight euro in the FX space. We like sterling here in the sense because there's a bit more stability there. They have gone through their.
So we've paid our dues now. Yes, it's now somebody else's problem.
Exactly, and there's a risk premium there, which we think that can be harvested against the euro, which is now facing a flavor of the same issue. So we think that versus UK, I think Europe is looking on the more underweight sense versus the UK.
How would, just out of curiosity, I'm just having a little bit of fun here. How would the market react if the UK the next government took a more positive view in its relationship with Europe? Would that be viewed positively?
100%, because I think we have seen now that the capex cycle in the UK structurally has been very weak since the Brexit development, and it is probably the most important macro impact of Brexit. So if there is any I think policy development which I think A, puts a floor under it, and B, gives that confidence back to long-term investors for FDI, for long-term portfolio flows, and we know our UK assets are under-owned globally. We speak to our clients, we have a very good sense that this is an underweighted market. So if that confidence starts to come back, that there is a more stable relationship with Europe, and I think that will change, and UK's valuation.
Do you just buy across the curve? Do you buy front end? Do you buy back end on that? The Bank of England is going to be cutting rates, but maybe not quite as far. In theory, though, a move back towards Europe would take some of the friction out of the system, so you could actually argue would be disinflationary. Yes. Would you just buy a basket, or do you pick specific points? We are actually focused
on the more of the mid part of the curve. Firstly, because we want to lock in some of these high rates. Ultimately, the cuts will come. Right, they are delayed, but ultimately it's a late cycle. The policy is restrictive, and we can argue whether it happens later in the year, and so on and so forth. But I think the cuts will likely come, so we want to lock in some of those high rates for the at the mid part of the curve, and I think it will benefit as well from some of those structural themes we are talking about.
Great to see you. Thanks for stopping by to see us. Very nice to see you. Simon Ahmed joining us from Fidelity International. Coming up, we're going to hear from the CEO of Citroën in France. The CEO over there, Thierry Coscas, is going to be joining us as well. We're going to be talking about the new Ferrari. Ferrari is coming up with an EV. Now, the list price, I think, is about 500 euros, 500,000 euros. Does it hold its value? Look at what is happening with Porsches. Look at what's happening with the Porsche EVs. How well they're holding their value. Ferrari might be different, but we'll talk about that next. Anyway, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. Let's talk about what is happening with the car market. Slowing demand for electric vehicles, along with, of course, new tariffs on imports from China, has European automakers very much focused on affordability. Today, Stellantis announcing a new electric SUV that, for now, is the latest expensive EV made in Europe. Citroën brand CEO Thierry Cosgas sat down with Bloomberg's Francine Lacroix and shares what he sees in store for the EV market over the coming months.
I think that the market remains fairly strong. It's progressing year on year. So we are very confident that the market conditions will be favorable in the months to come. It's very much a question of being able to offer the cars that the customer needs, particularly electric vehicle. You know that we are selling more and more electric cars. We need to be able to offer affordable electric cars, and that's what we are doing with the new C3 Aircross.
So talk to me a little bit about, in general, you know, the slowdown has been more pronounced for EV cars. And again, this varies from country to country. This may be because some of the incentives have been removed. How do you see demand for EVs in general? And also, how do you see demand for the new C3?
Well, actually, yes, I understand that there is a slowdown in some countries, but we shall not forget that anyway, we have to grow the share of electric sales. Just to give you a very concrete example, in 2025, we will have, like any other manufacturer, to double the share of electric cars in our sales. This is the short-term objectives that we have to face. So at the end of the day, we have to sell electric cars, and we have to sell electric cars profitably, which means we need to be able to offer products that the customers want. And when we look at the new EC3 we revealed a few months ago, first European electric car below 25,000 euros. Now today, the new EC3 Aircross, electric SUV below 30,000 euros. We are coming with very attractive offers, and we think that it will enable to grow the electric car sales for Citroën.
But do you worry about pricing? Or are you very sensitive to that, especially depending on the kind of market or the country you're in?
Well, obviously, pricing for electric cars, it's a big challenge. So we have to overcome that with, first of all, very competitive offers. That's what we have today. Today, you do not find an electric SUV below 30,000 euros. We are introducing that in the market. But also what I would like to highlight is it's not only a question of price, okay? It's going down, it's great, but it's also a question of usage cost. If you use, for example, a C3 Across electric compared to a petrol version, you will probably save up to 1,000 euros per year. So it's absolutely significant, which means, yes, the selling price may be higher. You can finance the car, obviously, but then in terms of usage cost, the customers will enjoy a much more favorable usage cost. That's very important to take into account.
Yeah, but if it's not translating into consumer demand, then it's quite tricky. I mean, the other big thing is, you know, the incoming additional EU tariffs on Chinese EV imports. Are you expecting that to give a boost, a big boost to the EV market in Europe?
Well, obviously, the Chinese offensive is there. The Chinese competitors are coming, and they are challenging us because they are coming with very competitive offers. So what we need to do is to fight with the same weapons and to be able to produce cars at a competitive cost versus the Chinese. This is what we are doing with C3 and C3 Across. We think we have very competitive cost base for a car made in Europe that will enable us to face the Chinese competition and participate to the growth of the electric market in Europe.
Thierry Coscas, the CEO of Citroën, the brand, joining Francine a little bit earlier on. Let's talk about supercars a little bit more. The first ever electric Ferrari, we now think has a price tag. Reuters is reporting the model will cost at least €500,000, and that's without the, of course, necessary add-ons that probably adds, let's call it 15 to 20% on top of that. The company's CEO is confident the car will sell just as well as its combustion engine models. Probably wouldn't sound quite as nice, but that's neither here nor there. The model is expected to be unveiled in the fourth quarter of next year. Blue Air's Craig Trudell joins us now. Why? Like, we'll just talk about Ferraris and whether or not they should be doing this. That's a whole separate offline conversation. But B, is this something that Ferrari is assured of being able to make work? Is an EV Ferrari a dead cert?
Yeah, I mean, just listening to the CEO very recently, I don't think that is necessarily a cut and dry answer, that he necessarily had a cut and dry answer to that question. He pointed to the notion that some younger consumers, for them, absolutely, it's something that they want, and they wouldn't consider Ferrari unless they were to offer an electric vehicle. But there are diehard consumers who want nothing to do with it, who this is not what a Ferrari is. The late Sergio Marchionne, made comments before he passed about, essentially, you can make an SUV over my dead body. He was similarly, quite downbeat on the notion of making an electric Ferrari. These supercar brands really do have a difficult, sort of gap to bridge here of, what they've been known for, what their heritage is based on, to make this transition.
One of the things about Ferraris is they hold their value quite well. Now, that's not what you're seeing in some of the other supercar makers that have gone down the route of building EVs, like Porsche, okay? So let's just talk a little bit about Porsche for a second. I'm on the Porsche website. I'm looking at it now. I'm looking at Taycans. 2 years old, 30-odd thousand on the clock. Let's call it 30, 40, 50% off the initial drive out of the showroom price. They have not... Some of these vehicles have not held their value particularly well relative to ICE engine Porsches. Is Ferrari running the same risk?
I think especially when you are talking about a price that is high even for Ferrari, I absolutely think that that's a valid question to ask. And, reading the Reuters report this morning, it was somewhat surprising in the sense that they do have a sort of threshold in mind, at least according to their reporting. But it's not necessarily, as you alluded to in the intro, these starting prices are really, just sort of somewhat arbitrary. And what these customers actually pay, money is to at least some degree no object for the clientele that is buying a Ferrari. Also, the sort of, amount of volume that this company does, potentially it has the ability to have a better handle on these resale prices. Ferraris don't necessarily change, hands, a lot. And so maybe this is not necessarily as big an issue, but it certainly will be the case that, this also will be a first model that is very historic. And, do they strategically try to keep production even more limited than they would track record that we've seen?
What's it going to do? How fast is it going to go? The acceleration is going to be presumably unbelievable.
That's the thing. I mean, much as there are trade-offs here, the lack of at least authentic sound, the company has talked about the idea of inauthentic, noises. There is just massive opportunities here in terms of performance. So, the customer is not going to be losing out in terms of 0 to 60, even if there are some other trade-offs.
In terms of where this is going to fit in, is there going to be some cannibalization effect, do you think? Is this is this the new market, or does this hit into the existing market?
I think, again, going back to what the CEO has said, a younger consumer is very attracted to this. So I think there's some possibility that this opens up a new market. This, of course, though, is a market that is only so big, and some consumers, just absolutely this will always be aspirational for them.
Craig, nice to see you. Thanks for stopping by, Craig Judell. On the new Ferrari, we'll look forward to seeing it and seeing what it can do. Talking of performance, there's a distinct lack of it in global markets right now. The United States is closed for the Juneteenth holiday, as a result of which there's a distinct lack of volume. The Stock 600 is going nowhere in a hurry. US futures are going nowhere in a hurry. The pound's actually catching a little bit of a bid today, but even that is beginning to fade. Anna Rathburn, CBIZ Investment Advisory Services CIO, will be joining us in the next hour. Stick with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. Go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back, folks. You're watching Bloomberg Markets. I'm Guy Johnson in London. It's Wednesday, the 19th of June. It is Juneteenth in the United States. It is a holiday, as a result of which we don't have cash trade in the bond market or in the equity market. We do have futures trading, but even that's not really proving to be particularly exciting. So European equities are doing nothing. We don't have US volume to give us the boost in the afternoon, so we're trading sideways, looking for another catalyst. S&P futures are doing absolutely nothing. We're waiting for a fresh catalyst. Maybe we get that in the back end of the week. The pound is a little bit bid this morning. We saw CPI coming back down to target 2%, but services inflation remains sticky. That feels familiar, doesn't it? And we continue to keep an eye on what is happening with the French story. French bonds are on offer once again today, and we have fresh warnings now coming from Brussels in terms of its deficit. But the story, of course, so far this week has been, well, there's been two stories this week, hasn't there? One of which has been French politics, which has been dominating. The other one is this continued and relentless rise of US tech. I say US tech, I really mean NVIDIA, don't I? Let me show you a chart. This just gives you an idea of the scale of the rally that we've seen in this company and the market cap additions that it has added. And you can see that quite clearly, the yellow line, and just how upward sloping it is. It has caused the rest of big tech and overtaken it. It's in the 3 trillion club at NVIDIA. I saw a note a few weeks ago from Torsten Slock over at Apollo. 35% of the increase in the S&P's market cap since the beginning of the year, this was a few days ago, has come from one stock. That, of course, is NVIDIA. So what do you do with this? Why are you buying it? What is the reason for holding it? And can it carry on delivering these kinds of gains? What does it mean for sort of your portfolio and how you construct it? Let's try and answer some of those questions. Anna Rathburn, CBIZ Investment Advisory Services CIO, joins us now. Great to see you. Thanks for joining us on the holiday. Anna, what is the case for continuing to own NVIDIA? It does seem as if everything else has fallen by the wayside, and this is the stock that continues to power ahead. Is it just like a black hole? Is it just going to continue to suck money in day after day, month after month?
Well, it certainly has been. So it's been very difficult for diversified portfolios to outperform because of this one stock. I mean, we had the Magnificent Seven talk at the beginning of the year, which turned into Fab Four, and now it is just NVIDIA. I think some of this has to do with the fact that there are headwinds in the U.S. economy that's being reflected in the price of other stocks. Let's talk about regional banks, for example. Last week, we saw them fall. These are sort of realities that are being priced in. NVIDIA is really about the future, not necessarily today. And so I think people are piling into it because there aren't too many interesting things and there are risks that they're a discount in other stocks. The other component is, look, they have a crazy amount of market share in chips, and everybody is experimenting on AI. So if we look at the pipeline, not only do we have Max 7 companies actually incubating these things, and by the way, those companies also have a large amount of cash flow and very little debt, right? And the other thing is on the venture side, what we're seeing here is that capital is actually getting pretty dried up, and it has been for almost 2 years on the venture side, unless you have AI hanging from your shingles. So as long as there's a good pipeline of companies willing to experiment on the application of AI, I think NVIDIA is still going to be doing well.
But given the gains that we've been made, is this the right place to maybe hide from the kind of gathering storm? There seems to be this argument that this is the stock you want to own. Everything else is kind of there are lots of reasons to not own everything else. The US economy is beginning to look a little bit more fragile. You want to hide out in NVIDIA because it's got all the momentum. Does that argument hang true? I hear what you're saying about the strength in the AI story, but is that enough, do you think, to continue to propel this story higher, this stock higher? And is it enough, do you think, to make this stock the place that you want to hide out? Is it a safe haven or is it something else?
Well, NVIDIA stock is not U.S. Treasury, right? So I wouldn't consider that if there's a huge correction in the market, a technical correction or whatever it might be, or recession driven, let's say, NVIDIA is not going to be completely immune from it. So I wouldn't call that a safe haven. The AI thing is more of a long-term play, right? So if we look at the short term, what are we looking at? There is a technical danger because it is priced so high. It does have robust market share, but looking out, we have to ask ourselves, what is actually priced into these highs? It's really the future revenue, future demand. And I know NVIDIA has been actually outperforming expectations, but if the day comes, I don't know if it's an if or a when, but when the day comes, when they actually underperform that expectation, I think the shock would be pretty high. And that is the argument for diversification, because nobody has a crystal ball, and these expectations are actually there's a little bit of a crowd sentiment to these expectations. So it's priced for perfection, and perfection that we can't even really forecast.
Yeah, some of the positive forces, like the options trade, that are getting it propelled higher and higher, maybe going to reverse, and you could see, negative gamma on the stock. That would be certainly something that would ripple across the wider markets. And you've mentioned diversification a couple of times, so let's talk a little bit more. Do I have to therefore accept that my portfolio is going to underperform the wider market just to kind of give myself some risk protection? There are lots of things happening right now, lots of uncertainty. Do I just have to accept that my diversified portfolio is going to underperform so that I can sleep at night?
It's a hard pill to swallow for diversified portfolios out there. But when you have a very narrow market leadership, I think it's okay to accept that underperformance for the short term. I'm not saying don't have NVIDIA because it's the largest company in the world. You do need exposure to it because, again, this is infrastructure, tech infrastructure, not even really software that we don't know if there's going to be demand, right? So it's a little bit of a different story. But narrow leadership is what would actually cause me to accept the underperformance, not necessarily NVIDIA itself. It's just the market isn't very healthy right now.
What do I diversify into?
Well, there's rest of the market outside of NVIDIA. In the S&P 500, there are 499, S&P 499. I guess that is what. And then there's, of course, also small caps. So let's talk about small caps for a second. It has underperformed, and a lot of that is tied to interest rates, right? So the Fed is saying higher for longer, et cetera. It gave us some direction as to the first rate cut coming at the end of the year, potentially one rate cut, right? If the Fed starts to cut rates, there's room for more risky and more rate-sensitive areas of the market to run. We just don't know when. And if you're a long-term diversified portfolio, we're not market timing. And so it does pay off to hold it, hold things that are not NVIDIA, 499 stocks of the index, because we don't know where policy will go. We have elections. I mean, the last several weeks have taught us something about risks of elections. I think it remains prudent to be diversified and not necessarily chase the winners.
So do I just buy, is it as simple as buying the S&P and buying the S&P equal weight? Does that give me enough diversification?
So I think so equal weight definitely has been underperforming large market, the market cap weight. And I think that's the market telling us something, right? I think the market is telling us that where capital is going is where the opportunities are. So I'm not a huge fan of equal weight because that is us basically deciding where capital should go. So I think S&P 500, you know what? If NVIDIA is going up, actually ride it. But the way to actually deal with the diversified portfolio is to rebalance and have a rebalancing discipline. If you have growth versus value, and growth is running really hot because of NVIDIA, ride it, but then you need to rebalance that back into value. I think that is a more prudent way of doing it.
Anna, great to catch up. Thanks for joining us on a holiday. We really appreciate it. Anna Rathbun, CBIZ Investment Advisory Services, CIO. Thank you very much indeed. Talking of risks, we're going to talk about them next. We're going to get the latest from the upcoming French election. And remember, the EU scolding France and Italy today on their budget deficits. We'll talk about that story as well. This is Bloomberg.
names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Wednesday, the 19th of June. Welcome back. Let's talk about French politics. Let's talk about how French politics fits into EU politics. France and Italy both have been reprimanded by Brussels for running big deficits. It's the first stage in a confrontation that will test the bloc's resolve and could, in theory, prompt billions of euros in fines from Brussels. It could get quite feisty, I think. It is probably me underestimating the situation. You've got Meloni in Italy. Potentially, you're going to get Le Pen in France. We'll see how she would react to such an edict coming from Brussels. Uncertainty in French politics, obviously the dominant theme over the last few days. So let's kind of wrap this all together into one nice, neat bow. We're joined now by Caroline Kernan from Paris. Caroline, first of all, how has this reprimand in any way resonated in France? Are people paying attention to what Brussels is saying? Are the politicians paying attention to what Brussels is saying?
I think they are, and I think it's quite interesting, actually, that you put Le Pen in France and Meloni in Italy together, because what Marine Le Pen is trying to do is clearly to show that she is like the Meloni type, but in France, kind of scary at first for the markets, but trying to reassure and not that scary after all. At least that's what she's been trying to tell the markets over the past couple of days, since this weekend. And even Jordan Bardella, her ally, who would become prime minister if the National Rally gets a majority on July 7, actually has been repeatedly saying that the first thing he'll do if he becomes prime minister would be an audit of French public finances, and that his ambition is to show his fiscal seriousness. So clearly Marine Le Pen and Jordan Bardella are going to seize this opportunity to attack Macron again on the way he's left France in terms of deficit and debt.
Okay. Let's say they did form the next government. Let's say that Bardella was the next prime minister. The party's fairly Eurosceptic, and I wonder how they would react were this confrontation with Brussels to escalate. You'd obviously have Meloni in the mix as well. How do you think that Eurosceptic sort of nature would interact with potentially a threat from Brussels?
I mean, they want a Europe of nations, so basically putting a double border, another border within Europe as well, between the various countries, even though Jordan Bardella has not exactly explained how he would technically do that. So that is a potential fight here with Brussels. But clearly what they've been trying to do here is to reassure in terms of deficit. I will actually try to ask Jordan Jordan Bardella, who is speaking tomorrow at this business lobby event, MEDEF. He is going to be asked about his economic program, and I will try and put that question to him, whether, you know, he will respect the 3% deficit target if he does become prime minister. We'll see the details of their programs, hopefully over the next few days. We still haven't got the details, but to put this into perspective, back in 2022, when Marine Le Pen was candidate to become president, her program was estimated to cost 100 billion euros for France. And now Bloomberg Economics is saying that the current measures they've presented would only cost about 8 billion euros. So clearly a huge change from what they were trying to do in 2022. And that's clearly an attempt to appeal to mainstream voters.
Caroline, what is Bardella saying on defense?
So Jordan Bardella was actually today at the Eurosatori forum north of Paris, which is about a military forum. And he was saying that his intention is to not send any French troops to Ukraine. So trying to echo here or respond to what the President Emmanuel Macron was saying a few months ago about sending troops as a last resort if France was in danger. So Jordan Bardella is saying they will send ammunition to Ukraine, but not any troops. And they're also against this idea of Emmanuel Macron of sending French army instructors to Ukraine. They say that their red line is to become co-belligerent.
I wonder whether the Mirage 2000-5s would go as well. We'll see whether that story evolves as well. We'll watch that space very carefully. Caroline, thank you very much indeed, Caroline Carnan, on what's happening with France. Let's turn to the UK next. We'll come back. We'll talk about UK CPI, back to 2%. However, services inflation still remains very sticky. We'll talk about that next. This is Bloomberg.
This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Okay, we talked about France. Let's talk about what's happening in the UK. The Prime Minister, the current Prime Minister, Rishi Sunak's Tories, on track, we think, to lose 2/3 of the seats they won at the last general election. Now, this is according to the latest analysis from the polling group Ipsos. We're 2 weeks away from the UK going to the polls. So let's talk about how Jim Ratcliffe, the UK billionaire, now relocated to the south of Europe, to Monaco, how he is seeing things evolving in the UK. He says this country is ready for a change. He said this in a conversation with Francine Lacroix.
You've got immigration, which is one issue, and the other issue is the economic issue. If you just look at the economic issue for the UK, it's really, in my view, it's quite simple. Is the UK economy is £2 trillion. The GDP is £2 trillion, and the government take half of it, at least half of it. So the government spend is £1 trillion. Right. So, in my view, they're major. And if you look at INEOS, we spend 60 or 70 billion a year, something like that. The government spends 1 trillion. That's an awful lot more than us. So you need to spend the money well, because you're not spending your own money, you're spending the population of the UK's money. And, you know, there are good reasons why people pay taxes. You've got, you know, healthcare, you've got police, you've got roads, all those types of things. And I don't think the government manages those things very well, and I don't think it focuses on them very well, and I don't think it's got the right quality people running them. But they're spending £1 trillion. You know, the health service is a mess. We don't have security anymore. Education's a bit of a mess. You know, we can't run sewage systems in the UK. I mean, you know, we had sewage systems running in the Victorian era, and you know, we allow all the utilities. I mean, just take that as a simple example. We allow all the water utilities to be sold off. They were mainly bought by French companies. Then the French companies pay £50 billion in dividends, but don't reinvest in the equipment to ensure that we've got top-class equipment to manage our, you know, sewage and drinking water facilities. And then all of a sudden it's a crisis. I mean, why doesn't the government say, we want to buy our water utility, then these are the minimum requirements you need to, you know, and if the people don't behave, then do what they do in America, they block them up. You know, there's some consequence if you misbehave. So you've got that whole issue of the economy, and then you've got immigration, and they haven't dealt with immigration. They've sort of danced around. But I think we had 500,000 people come in the UK last year. Well, 500,000 people is 2 times the size of Southampton. I mean, 2 Southamptons in a year, and you think about all the infrastructure. One of the basic problems we've got in because we've allowed so many people into the country, and that will go on forever because, you know, we speak English in England, and all the planet speaks English now, and there are 8 billion people in the planet, and there are going to be 10 billion people by 2050. So there's always going to be a flood of people trying to get into the UK, so they need to be able to deal with it. But we probably have got, you know, an infrastructure for 50 or 55 million people, and we've got 68 million people. So the hospitals don't work, the roads don't work, nothing works. And, you know, at the end of the day, somebody has to say, no, you can't, you know, we can't take any more people in. Because if you bring 500,000 people in a year, how many schools do you have to build? How many roads do you have to build? How many sewage systems? How many police stations? And we're not doing that. We're just sort of cramming them all in on the existing infrastructure, and it doesn't work.
How do you think Labour will deal with that? Do you think, you know, Sir Keir will be a good Prime Minister?
Well, I think he's a very sensible man, and he's an intelligent man. So I don't know. I think you probably have to do some unpopular things to be able to get those types of issues dealt with. It's like at Manchester United. I'm having to do some things which are unpopular, but I mean, I'm happy to do it in a political environment in a way. You know, it's a bit. I mean, I think at the end of the day, doing difficult things and, you know, a degree of unpopularity in a funny sort of way might make you more popular because somebody's seeing that you're standing up and making some difficult decisions rather than just sort of blowing with the wind a bit. I don't know. I mean, time will tell. I can't predict how that will all go.
INEOS Chair and Founder Jim Ratcliffe speaking to Francine Lacroix, painting a positive and, dare I say, sunny picture of what is happening here in the UK. I joke, of course. I feel much better after listening to him. Let's turn our attention to some good news that we do have coming out of the UK, but it's kind of a little bit of good news and maybe not completely good news. UK inflation is back to the Bank of England's target. It's the first time we've been there in almost 3 years. Supports the case, of course, for an interest rate cut from the Bank of England, maybe in August, maybe in September. Last time around it was 2.3, so we've come down at the headline quite significantly. The problem is that service sector inflation remains very elevated and quite sticky. And Andrade from Bloomberg Economics joins us now. Presumably the Bank of England's going to focus on that services story, and maybe a little less so on the headline number.
Yeah, morning. Good afternoon. So yeah, the
It can be
services
both.
it can be both. The services inflation is really what they're sort of I've identified as one of the indicators measuring persistent price pressure.
Yep.
The other one is wage growth, but the wage data has been a bit volatile, and the committee has expressed a preference to focus more on services inflation rather than wage. So the sort of surprise that we got today, this morning, and also on the April CPI on services inflation, it's a bit too high. It's a bit too uncomfortable.
Why is it so sticky? What are the factors that are contributing to this stickiness? And are any of those going to abate anytime soon?
Yeah, so I think part of the story is that in April is just sort of an awkward month for inflation because you have a lot of prices being updated at once, and you also had a 10% increase in the national minimum wage.
Right.
And so the question is, you can have sort of an increase in costs, like wage costs, and that does need to pose a threat to inflation if the firms don't pass along those higher prices. And the PMI that we had got for this past months, it did suggest a bit of that. It did suggest that was happening a bit. So input costs were rising, but firms were not passing on. But then the CPI data sort of told us a little bit of a different story. It told us that, you know, the economy is cooling and the labor market is cooling, but you're still in an environment where firms feel confident to pass on a little bit of those higher costs.
Just in 20 seconds, therefore, you expect now a slower rate of cuts.
Yes, we expect a slower rate of cuts because of that persistence. Because the BOE, a lot of progress has been made with headline inflation. It's important for the BOE. The BOE is likely to start ease policy in the summer, but the persistence will sort of hold it back.
Anna Andrade, thank you very much indeed. Bloomberg Economics is Anna Andrade. Coming up, we're going to turn to the Fed and what we're hearing in terms of the latest guidance as to when the cuts finally start over there. That's next. This is Bloomberg.
portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together in how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
back. Wednesday, the 19th of June. It is, of course, Juneteenth over in the United States. Therefore, markets are closed. You do still have futures trading, but cash trading is shut for the day. The Stock 600 here in Europe is pretty much unch. Nothing going on, nothing to see here. Volume has been taken out with the US on holiday, and therefore we're waiting for tomorrow. Similar story on futures, as you can see, 1/10 higher. The pound is a little bit bid this morning, but again, no real action there. This is a very exciting board, I have to admit. And then you've got a little bit of movement in French bonds. We're watching that quite carefully. So French bonds, the OAT, on offer this morning. So far in this hour, we've talked already about what is happening with the story with France and the EU. We've talked about the Bank of England. I probably should have mentioned as well what is happening with the S&B tomorrow. That could actually be the surprise, the Swiss National Bank. Just keep an eye on the Swiss National Bank. Could be providing, once again, a little bit of a catalyst for markets. But, of course, the one we're really watching for to find out what happens next is the Fed. And we've had a chorus of Fed officials speaking this week, urging patience when it comes to rate cuts. Take a listen.
We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at one or two rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both.
I will need to observe a period of favorable inflation, moderating demand, and expanding supply before becoming confident that a reduction in the target range for the federal funds rate is appropriate. These conditions could take months and more likely quarters to play out.
I believe economic conditions are indeed moving in the right direction. If the economy evolves, as I expect, it would become appropriate to begin easing policy sometime later this year.
Joining us now, Brian Jacobson, Annex Wealth Management Chief Economist. Brian, great to see you. Thanks for joining us on a holiday. The market's kind of pricing in 2 rate cuts this year from the Fed. We've kind of become a little bit more aggressive in our thinking over the last few days, given what we've seen in the data. But the Fed is still saying that we should be cautious. Who's right, do you think, right now? The market or the Fed?
I actually think that the market is getting it right. For a while here, the market was underestimating the resolve of the Fed in terms of the rate hike path. But if we kind of take a step back and just think about what the Fed has done with their communications over the last couple of years, it actually reminds me of in the movie Top Gun, where the commanding officer told Maverick that his ego was writing checks that his body couldn't cash. The Fed had been really saying things that their policy couldn't deliver on. And that we saw that with Chair Powell initially, before they started hiking rates, saying how we would welcome higher inflation because we know how to fix that. Well, so much for that. Then he said transitory only meant 6 months. So much for that. Then he said there will be pain. Well, so much for that. So I think that they're actually trying to demonstrate a lot of humility, and they're just going to basically spring a rate cut on the markets probably in September, even though right now they're really saying that it's too soon to tell.
Do you think the data will support such a move?
It should. This past week, with the data we had on retail sales showing a very weak bounce from the negative growth in retail sales in April, I think that is quite telling that consumers are beginning to feel the pinch. We did see an increase in manufacturing output, but that was after 2 consecutive months of a decline in manufacturing output. CPI has been moving lower, and I think that really, by the time we get to the September meeting, it will be appropriate for the Fed to start cutting rates. Now, the big question is are they actually willing to do it? Are they going to believe the data, or are they going to wait for a few more months of data to support the idea that they should start cutting? Yep. That's where I think that it could actually be rather treacherous for the markets if they wait beyond September.
Yeah, I want to come back to the kind of surprise factor in just a moment, but let's just stick with the consumer if we can for just one more question. If I look at the University of Michigan data, I see the consumer becoming more pessimistic. But the reason I see the consumer becoming more pessimistic is because inflation has reaccelerated for the consumer, and that's starting to impact their behavior. That reacceleration that the consumer is feeling of inflation should be presumably something the Fed should worry about.
Yeah, the Fed is very aware that really monetary policy, it's incredibly powerful, but they don't necessarily have a lot of control. over how it actually influences the economy. One of the channels is through people's expectations of what inflation will be. It almost becomes a self-fulfilling prophecy. So I think that the Fed is actually incentivized to try to maintain this hawkish rhetoric. But in the sentiment surveys, I think it's important to recognize that those surveys don't necessarily income weight the respondents. If you look at consumer spending, it is mostly driven, about 40% of consumer spending is by the top 20% of households by income. And so if they were to do a different weighting of the actual sentiment surveys, I wonder if we'd get a clearer picture or more of a harmony between what the sentiment numbers are saying and what the sales numbers are saying.
Joanna Shu at the University of Michigan is watching. Maybe we could do that. Brian, let's talk about the surprise you talked about, the fact that maybe the Fed is going to spring a surprise on the market. How do you think the market would react to a surprise after so many years of the Fed trying to do exactly the opposite?
Yeah, I think that it would actually be an opposite of what we saw during the taper tantrum. So every time around this time of year, I remember back, I think it was 2013, when Chair Bernanke talked about how the Federal Reserve was going to start tapering their asset purchase program, and that caused all sorts of, kind of threw the market into a bit of a tizzy. This could be the opposite of that, because it would actually be really a rate cut instead. I would actually expect that maybe at the Jackson Hole meeting in August, that's where Chair Powell might kind of prime the market for the idea that they can start tracking inflation lower with cutting rates. So I think that would actually be very positive. Right now, we have very tight credit spreads, but I think that's mostly not because corporate yields are too low, but because Treasury yields are too high. And that's really what, the difference is what defines the spread. So I expect that we'll probably see yields across the board move a little bit lower, and it could be more of that risk-on rally, more favoring small cap value stocks, almost as though it's kind of the typical playbook for when an economy is coming out of a recession. Yeah. I think it would actually be a sigh of relief that we are continuing to avert a recession.
Brian, last time we saw this happen, and it was back in December, the Fed effectively loosened financial conditions significantly. Asset markets took off in a really big way, and the Fed has had to deal with the consequences of that, because that has had an impact on the economy, it's had an impact on spending, it's had an impact on inflation. Why do you think this time will be different?
Yeah, the financial conditions measures, I actually question how well they measure actual financial conditions or the relevant conditions. Most of them look at the stock market, credit spreads in the public markets, and things like that. But really, the financial conditions that matter for monetary policy are more the financial conditions of households and small businesses. So even though these financial conditions measures, to make them daily or of a high frequency, they tend to focus on the bigger companies that are out there. But when you look at the actually bifurcation or the difference between how it is that bigger companies are doing versus smaller companies, I think that leads me to believe that financial conditions aren't quite as loose as what the data might suggest. It's not just the availability of credit, it's the cost of credit as well.
Is there a danger that risk assets look at a rate cut and say, the good times are over? The Fed clearly sees something that we don't, and we should be worried about, and risk assets react negatively to that.
Certainly. I think that is the playbook that a lot of people are looking at. The previous rate cuts, it was oftentimes because the Federal Reserve was too late to recognize that they held rates too high for too long, and so they had to start cutting rates. Now, it's different, though, in the sense that they're able to cut rates because inflation is falling and growth has gone from great to good. I don't think growth is going to go from great to good to grisly. It's more that it's going from great to good to sustainable. So it's really the key thing is the conditions are a little bit different for the setup. The market might price it in, looking at the past playbook about the Fed is cutting, therefore we must be in a recession, and then you get the market drawdowns. But if that does happen, I would view that as a tremendous opportunity to reallocate into risky assets.
Okay, does risky assets include big tech? This is the question that I think a lot of people are trying to figure out right now. NVIDIA keeps going up. Does it keep going up because it's a risky asset and is a growth stock, or does it keep going up because it's a safe place to park my money because everything else looks so horrible?
Yeah, it is become a little bit more like a defensive. Tech companies are really cash flow generators, unlike during the tech bubble where they were just basically, sucking up all the cash, and it was a great way to put it down the garbage disposal. But now they're actually generating the cash, and NVIDIA, according to our models, we still hold it across a number of our individual equity strategies, and just recently it has gotten up to what we consider fair value. So it was undervalued based upon things like, current earnings and then prospective growth of their earnings. Key thing is going to be how well they can defend their moat, right? It's very similar to as far as what happened with Intel and AMD. Intel was dominating things, but then you had a number of companies coming in to compete with them. Right now, NVIDIA seems to be almost the only game in town, and so as long as they can maintain that, they should maintain sort of their characteristic as being somewhat more defensive. But that can change on a dime, unfortunately, so it does require vigilant monitoring.
Yeah, that day will be an interesting day when that dime is flipped. Brian, thank you very much indeed. Brian Jacobson of Annex Wealth Management. Thank you, sir. Thanks for joining us on a holiday. Coming up, we're going to talk cars. We're going to hear from the Citroën CEO, Thierry Koskas. That conversation next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Talk about what's happening in U.S. banking. Citi says it expects banking fees to surge 50% in the second quarter compared to a year earlier, while revenue from its market business will be flat. Bloomberg's Sonali Basak caught up this week with Mark Mason. He is the CFO at Citi's. The company's Services Investor Day was the occasion for the conversation. Take a listen to what he had to say.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business and our security services business.
It's interesting because, to your point, even though security services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup's stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup's stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%, and we talked about the services businesses being a significant contributor to that, both in the top line and our services business is a 20% return on tangible common equity. In the wealth space, we brought in new management there, and we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure to increasing the banker productivity to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
Citi CFO Mark Mason in conversation there, of course, with Bloomberg's Sonali Basak. Meanwhile, let's turn to what is happening in the EV space. A slowdown in demand for electric vehicles, plus, of course, new tariffs on imports from China has put the focus on pricing for automakers. Today, Stellantis announcing a new electric SUV that, for now, is the least expensive EV made in Europe. Citroën's brand CEO Thierry Coscas sat down with Bloomberg's Francine Lacroix and shared his views on what he sees in store for the EV market over the coming months.
I think that the market remains fairly strong. It's progressing year on year. So we are very confident that the market conditions will be favorable in the months to come. It's very much a question of being able to offer the cars that the customer needs, particularly electric vehicle. You know that we are selling more and more electric cars. We need to be able to offer affordable electric cars, and that's what we are doing with the new C3 Aircross.
So talk to me a little bit about, in general, the slowdown has been more pronounced for EV cars. And again, this varies from country to country. This may be because some of the incentives have been removed. How do you see demand for EVs in general? And also, how do you see demand for the new C3?
Well, actually, yes, I understand that there is a slowdown in some countries, but we shall not forget that anyway, we have to grow the share of electric sales. Just to give you a very concrete example, in 2025, we will have, like any other manufacturer, to double the share of electric cars in our sales. This is the short-term objectives that we have to face. So at the end of the day, we have to sell electric cars, and we have to sell electric cars profitably, which means we need to be able to offer products that the customers want. And when we look at the new EC3 we revealed a few months ago, first European electric car below 25,000 euro. Now today, the new EC3 Aircross, electric SUV below 30,000 euro. We are coming with very attractive offers, and we think that it will enable to grow the electric car sales for Citroën.
But do you worry about pricing? Or are you very sensitive to that, especially depending on the kind of market or the country you're in?
Well, obviously, pricing for electric cars, it's a big challenge. So we have to overcome that with, first of all, very competitive offers. That's what we have today. Today, you do not find an electric SUV below 30,000 euros. We are introducing that in the market. But also, what I would like to highlight is it's not only a question of price, okay? It's going down, it's great, but it's also a question of usage cost. If you use, for example, a C3 Aircross electric compared to a petrol version, you will probably save up to 1,000 euro per year. So it's absolutely significant, which means, yes, the selling price may be higher. You can finance the car, obviously, but then in terms of usage cost, the customers will enjoy a much more favorable usage cost. That's very important to take into account.
Well, yeah, but if it's not translating into consumer demand, then it's quite tricky. I mean, the other big thing is, you know, the incoming additional EU tariffs on Chinese EV imports. Are you expecting that to give a boost, a big boost to the EV market in Europe?
Well, obviously, the Chinese offensive is there. The Chinese competitors are coming, and they are challenging us because they are coming with very competitive offers. So what we need to do is to fight with the same weapons and to be able to produce cars at a competitive cost versus the Chinese. This is what we are doing with C3 and C3 Aircross. We think we have very competitive cost base for a car made in Europe that will enable us to face the Chinese competition and participate to the growth of the electric market in Europe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's Let's wrap things up with a conversation about shoes and IPOs. Golden Goose has postponed its IPO. The luxury sneaker maker, backed by private equity firm Primera, has taken the decision to shelve the listing for now. It was going to be listing in Milan. Bloomberg's Andrea Felsted joins us to discuss. This was the private equity shop that took Dr. Martens to market, and it hasn't been great.
It really has not.
They can't have a repeat of that, basically.
Exactly. This is being blamed on market conditions, but that was probably a convenient excuse. They just can't have. It was pricing at the bottom of the range. It clearly wasn't going to pop on day one. They just couldn't have another Dr. Martens on their hands.
So what do they do with it now? Do they just hang on to it for another 6 months, bring it back? Is that what you expect?
I expect so. I expect it to come back. The question is, does it come back at the sort of punchy valuation they were looking at this time round? It was priced closer to Moncler. Really, it should have been priced closer to Dr. Martens.
Wow, okay. That's quite a big discrepancy. What does this tell us about what's happening with the IPO market kind of more broadly? Shein, Shine, I never quite know how to pronounce it. You're going to set me straight on that. Potentially listing in London. Can I read from what we're seeing with Golden Goose to the Shein IPO? Is there a connection?
I mean, it's a different sector.
Yeah.
They probably like
Fast fashion,
you could call Golden Goose, accessible luxury if you're being kind. Shein really is fast fashion, but there are some similarities. Shein really has a lot of risks, and again, they're going for a really punchy valuation. I never thought it would come before the election, but there were rumours a couple of weeks ago that it was coming very soon. It's now looking at the autumn. This has been happening. This is supposed to have been happening for ages. It still hasn't happened. Is it going to come later this year? Or, are they going to hold off because of some of the feedback they've had from investors over those risks?
Accessible fashion, is there a read across into the wider fashion market from the fact that they pulled this?
I think the read across is this was a very specific product, 90% sneakers. It's a bit like Dr. Martens, which was really, chunky boots. With those things, you do have a lot of fashion risk. And it's difficult to put your finger on, something's in 1 minute, something's out the next minute. You've got all these super fast TikTok trends. So I think, investors need to be just aware that things can go in and out of fashion.
Yeah, I tend to think that you just want to ignore all of that. Just stick with your own fashion. Andrea, very much in fashion. Andrea Felsted, thank you very much indeed. We're going to carry on in the next hour. Lizzie Burden's going to be taking you through that next hour. Thank you for watching. This is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet
is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
DOJ or other authorities
could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Live from London, I'm Lizzie Bird and welcome to Bloomberg Markets. Here are the top stories we're following for you today. We'll have full market coverage ahead and get a preview of the Bank of England's rate decision as UK inflation falls to 2%. Plus, the EU slams France and Italy for running big deficits. We'll bring you the latest on the confrontation that could prompt billions of euros in fines. And North Korean leader Kim Jong-un pledged to unconditionally support Russia in its invasion of Ukraine as he meets with Vladimir Putin. We'll also discuss that and so much more throughout the coming hour. But first, let's check in on these markets. US markets seem to be powering ahead, but here in Europe, stocks struggling to add much to their two-day rally. Traders really looking for fresh catalysts after they've digested the news that Nvidia has overtaken Apple as the world's most valuable company. So you're looking at the DAX trading lower 0.3%, the CAC 40 in Paris lower 0.6%, and the FTSE 100 in London actually higher 0.1%, but the broader stock 600 lower 0.1%. And if you break it down by sector, you've got about 7 out of 20 in positive territory. Basic resources leading the gains, higher 0.8%, but bottom of the basket, the laggard is technology, lower 1% today. If we look over to the Wall Street Open, you've got futures pointing to a higher opening stateside. US markets closed for the Juneteenth holiday today, though, and cash treasuries offline. But if we look to the European bond space, you've got yields edging higher, especially that 2-year gilt yield off the back of the UK CPI print I just mentioned for you, back at the 2% Bank of England target now, but services inflation coming in hot. Traders now seeing a 30% chance of an August rate cut compared to 45% before that data. The pound trading at $1.27, so a touch stronger there, and Brent at $85 a barrel. We can get a fuller view of the markets now with Colin Graham, who is Rebecco's head of multi-asset strategy and co-head of sustainable multi-asset solutions. He can give us his outlook on the year ahead. Colin, are stocks getting ahead of themselves? Do you reckon we're going to see a correction for the S&P in 2024?
Well, it's very rare you'll see stocks go up in a straight line. I mean, we have seen a couple of episodes of that, the middle of last year, for example. But, we still think that for the Magnificent 7 or 6 or however many are left, but Nvidia, they keep delivering on those earnings. And that's the key element here, that if they keep to deliver, then you can still see these stocks that you could consider expensive get even more expensive.
So everyone's excited about Nvidia. Put the Mag 7 aside then. Who's actually overvalued?
There are certain sectors that we would look at and say, okay, this doesn't really fit with how we think about the world. But there are some, we're focusing on the laggards. So recently we've been underweight Euro stocks. So we used last week's volatility around the French election call to buy back some of our underweight Europe to back towards neutral. So we're using this volatility to look at areas of the market we think are undervalued rather than trying to focus and sort of pick a top, if you like, because we don't want to fight the momentum here because the momentum is very strong and we just have to go with that. But we can look up and find these areas of value in the markets, and that's what we're focusing on.
That's interesting. So you see chaos in France and you run towards it. Which sectors are you picking then?
So again, if you looked at, again, from a top-down perspective, we don't pick stocks, but talking to our underlying portfolio managers who do pick stocks, they were saying the sell-off in some of the bank stocks has been unprecedented. Not going back to the Euro crisis, seeing some of these stocks down 20% month to date. These are areas where actually the earnings this last quarter have been very good. So you can just see there's a bit of positioning changes, and those are the sort of areas that we sort of look at from that perspective.
And what about the UK? Because there's this debate, isn't there? Do you buy it while it's cheap? Are the fundamentals actually strong? And then layer on the election, does it actually change anything when markets are so ready for a Labour government because of the polling?
Yeah, exactly. So most elections, there is a risk premium that going into an election. We've seen that. We saw that in Italy. We saw that with Donald Trump in the US, where you go see a change in government, and then afterwards that premium comes out and everything calms down. But you haven't got that in the UK at the moment because everybody's so focused that Labour's going to win. So everybody's already priced that in.
And when we think about central banks, we've had the Fed saying that we can only probably expect one more cut this year. How much do you think that that's going to hurt the small caps?
Yeah, well, that's our biggest underweight position in terms of US small caps. Less so in Europe, but US small caps, because they're the ones that have been affected by the rise in interest rates more so because they go to the bank to get their cash, because they're generating cash. So they can raise it in the market. They can go to the high yield market or the investment grade market and get their funding, which again doesn't really affect them day to day. But small caps is where we see the pressure.
And I mentioned this UK inflation number that we got earlier this morning. We've got a Bank of England decision, of course, tomorrow. Is it going to be a non-event?
Well, fingers crossed that they manage to navigate that as a non-event. But yeah, I think that people are focusing later in the year. I think with the Fed sort of saying only one this year, then it makes it very difficult for other central banks to start a significant rate cut cycle.
Yeah, I mean, we had that services inflation print actually quite disappointing, even if the headline number came back to target. Traders have changed their positions. Does it change your view on how slowly the Bank of England's going to have to cut rates this year?
Not really. I think they'll cut rates when they need to, and I think they're in a position where unemployment is low, inflation's coming down. It's been slower than most people thought, but prices are still rising. That's what people forget. The CPI has come lower, but actually your day-to-day goods are still going up in price, and so that's the thing that voters will see, that their basket of stock, goods is more expensive now than it was last year and the year before and the year before. So that's what people say. So from our perspective, we look at things like the misery index, which puts unemployment and inflation together. And if you look at the Eurozone, you look at the US, we're back to close to low. So the populace should feel reasonably happy about life at the moment. But we can see from polling that's not the case.
Yeah, and how does that affect the consumer then?
In terms of, they want change, and they say, okay, my wages are not going up as fast as my basket of goods, so therefore I feel poorer, therefore I need a change of policy.
Because, of course, there is the debate over the untapped savings as well, but I also just want to bring in the ECB, because you say a central bank cuts when it feels it needs to, but there is the debate over whether the June cut happened just because it had been so over-telegraphed. Do you think that, in retrospect, that's going to look like a policy error?
I think we're discussing that, and it might be seen as precedent because actually with the turmoil in France, actually a lower interest rate will help with the concerns about debt sustainability, the fiscal spending. So from that perspective, I think it sort of is okay. But yeah, we think that you're starting to see the global industrial cycle turn up. And we had the good PMI from the US yesterday. So you're starting to see this pick up, which will be good for Europe, be good for China. So from that perspective, you're looking at it going, well, actually, if that's happening, weaker euro, better global growth from an industrial perspective, that's a positive for Europe.
And just before I let you go, Colin, can you just explain why you closed and then reopened your long commodities position? What's going on there?
Because we're a top-down team, there's certain things in commodity markets we don't understand. And we just saw a difference in pricing from the LME and the COMEX, which is the US exchange versus the London exchange, in copper.
We're like, it blew out to sort of 7 standard deviation event. And we're like, okay, we don't understand that. So let's close it out and just come back. And we saw that actually that's reverted. You've also saw the OPEC meeting coming up. So that was another reason to say, again, we don't know. So let's close it. And then actually we've got through the OPEC meeting. You're starting to see demand for oil start to increase. The US continues to pump oil into its strategic reserve. Copper prices have reverted, although you can see today that's beginning to blow out again, that spread. So from that perspective, yeah, we just thought we understand the fundamentals of the commodities, but we didn't understand the market pricing. So that's why we've gone back in, because the prices came back to the fundamentals.
Humility, I respect it. Colin Graham and Rebecca, thank you for being with me, giving us your market update. And we're going to discuss plenty more of this on the programme. We're going to go to France, facing blowback from the EU for breaking debt and deficit rules. And we'll have more on that for you next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Lizzie Burden, and we're going to head over to Wall Street now, where Bloomberg's Shonali Basak spoke exclusively with the Citi CFO, Mark Mason. Take a listen.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business and our security services business.
It's interesting because, to your point, even though securities services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today, you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%, and we talked about the services businesses being a significant contributor to that, both in the top line, and our services business is a 20% return on tangible common equity. In the wealth space, we brought in new management there, and we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure, to increasing the banker productivity, to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
So an exclusive interview with the Citi CFO, Mark Mason, there speaking to Bloomberg's Shonali Basak. But I want to bring you back to Europe now. The EU has delivered a warning to France over breaking deficit and debt rules, triggering a process that could lead to fines while complicating campaigns in the country, with elections less than 2 weeks away. For more, let's bring in Bloomberg's Caroline Conan with more analysis. And Caroline, just talk us through what the EU slamming France means for the French snap election.
France, you know, is the sick man of Europe when it comes to debt and deficit. That's not me talking. It's the country CIO who was on Bloomberg earlier today. And clearly that sums up the situation, is that we knew this procedure from the EU against the excessive deficits in France would come, but it comes at a very bad time for Emmanuel Macron, because we're just 10 days away from the first round of the snap elections he called. So clearly the opposition and the national rally of Marine Le Pen and Jordan Bardella are going to seize this opportunity to again attack the president on how he's handled the French public finances over the past 7 years, because French deficit has reached 5.5% of GDP last year, which is clearly above the 3% target or limit set by the EU. We've already heard from Jordan Bardella, who would become the prime minister if the national rally gets a majority in the National Assembly. He's saying that his ambition is to reassure markets to put the public finances back in order. And the first thing he would do if he gets the job as prime minister on July 8th would be an audit of French public finances. So clearly this EU warning comes at the worst time for Emmanuel Macron.
So is the budget the reason that Le Pen's party is talking the way it is on defence, Caroline, when it comes to Ukraine? They're saying that they would back arming Ukraine, but not equipment that would trigger a broader war. They'd be up for sending troops into Ukraine, which of course contrasts with Emmanuel Macron's position. Does it all come back to the budget concerns?
I don't think it's necessarily linked to the budget concerns and the issue about defense spending. Clearly, what they're trying to do here is to reassure those who think that Marine Le Pen and the National Rally still have links with Russia and the Russian President Vladimir Putin. Because remember, back in 2017, when Marine Le Pen ran for president, she got some financing from a Russian bank. She even went to Moscow to meet at the time with Vladimir Putin. So even though she has been trying to distance herself from the Russian president since the beginning of the war in Ukraine. Clearly, the strategy from Jordan Bardella today, when he said that France will not send any French troops to Ukraine, is trying to appeal to a more moderate electorate who might be scared that this war will come to France. So he actually said, unlike Emmanuel Macron, because a couple months ago, remember, the French president suggested that he could send French troops to Ukraine if France was in danger, if there was a real threat from this war, from this invasion by Russia. And this is what he repeated again today. They'll send ammunition, they'll send support, but they will not send any troops there. And he's also again sending French army instructors to Ukraine.
Caroline Conan, we thank you. I have to say, I've just come from France today, from Cannes Lions, and it was stunning weather where you are, so lucky you, not so in London. But let's take you to some other news now. Meanwhile, Golden Goose has pulled the plug on its Milan listing as a sell-off in the luxury stocks and the return of political risk in Europe have threatened to dent appetite for the Permira-backed sneaker firm, even after it tempered its valuation expectations. Now, while demand was strong across the price range from the first hour of book building, the company said that the current market backdrop means it isn't the right time to list. Well, coming up on the programme, Russian President Vladimir Putin makes a visit to North Korea, and we'll have all the details of that visit, even the hug between the two leaders. That's coming next. This is Bloomberg.
This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
To the geopolitics now. Russian President Vladimir Putin arrived for his first visit to North Korea in 24 years, meeting with leader Kim Jong-un. The two leaders signing a treaty that Kim Jong-un says elevates their relationship to an alliance. And for more, we can bring in Bloomberg's Piotr Skolimowski from Warsaw. Piotr, just talk us through what the US fears could come out of these talks. They've been incredibly friendly, these two leaders, so far.
Hi, Lizzie. Indeed, it was a very friendly visit, and you saw a lot of pomp and circumstance around it. So obviously a red carpet, white horses, all sorts of things. It was really a show of friendship between these two leaders, and obviously it's the first visit in 25 years for Putin Pyongyang, and but obviously it also follows a visit by Kim in Russia. He was there in September. What happened after the September visit is actually what probably worries the U.S. the most. It was the moment when actually a lot of ammunition, artillery shells started to flow into Russia from Korea. What we have to remember is that North Korea has one of the biggest stockpiles of artillery that it's sort of inoperable when it comes to Soviet era artillery and weapons, which are obviously used by Russia in the war against Ukraine. So there are some estimates that about like 5 billion shells have actually been shipped, and it's really gave Russia a lot of advantage on the battlefield. And probably the fear here is that when Kim is pledging his unconditional support and backing for Putin, the concern is that those ties between those two economies and those two countries are going to grow even more. Russia is obviously in overdrive when it comes to its war economy. It's producing a lot of artillery shells, a lot of weapons, but additional help from Korea is going to make it even more difficult for Ukraine to fight back, and also for the West to sort of provide more support.
Well, on the ground, how does it change the situation in Ukraine?
Well, at this point, obviously, Ukraine is sort of having a bit of a breather, if we can say that, in the sense that there was this 6-month gap when no help from the U.S. in particular, which is obviously the main provider of the main or the most crucial weapons have been coming from. So over those 6 months, we have seen how much Ukraine is vulnerable in terms of if there's no support from the U.S. So at this point, when the weapons have started to arrive, when there are artillery shells, and obviously Western allies also started to allow Ukraine to use their long-range weapons a bit more in fighting back Russians, we've seen certain stabilization on the battlefield. So what we've seen is that the Ukrainians have fought back some of the advances that Russia has made, especially in northeast around Kharkiv, where we have seen quite a significant quick offensive that has been beaten back. But obviously now, if Russia is going to receive even more aid, even more support and artillery from Korea, that might be a bit of a concern for everyone.
Okay, Bloomberg's Piotr Skolimowski in Warsaw. Thank you very much for that analysis. Have to wonder what Kim Jong-un gets out of this as well. But clearly an interesting meeting of the two leaders after such a long time apart. Very friendly coming together now. But coming up on the programme, we're going to bring you another exclusive interview. This one's with Jim Ratcliffe, Britain's second richest person. That's coming up next. And this is Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Lizzie Burden. Let's check in on these markets for you as we get up to 3:30 p.m. here in London. It's not a terribly inspiring picture this afternoon for European stocks. It has to be said. Traders really looking for fresh catalysts now that they've kind of digested Nvidia overtaking Apple as the world's most valuable company. So the DAX in Frankfurt lower 0.25%, the CAC 40 lower 0.7%, the FTSE 100 eking out some gains, but the broader stock 600 also lower 0.2%. And if you break it down by sector, you've got fewer than half in positive territory today. Basic resources at this point, the leader of the board, higher 0.7%, but bottom of the basket now is real estate, lower more than 1%. And if we look over to the US, as I say, it's the Juneteenth holiday. Happy holiday if you're celebrating, but it means that markets are closed today. Cash treasuries also offline. But as we look to futures for the Wall Street Open tomorrow, they are pointing to a higher opening. And then if we flip over again to European yields, you've got them edging higher across the curve, across the continent, but I would just pick out the 2-year gilt yield because it's higher 5 basis points at 4.19%, and this is partly because of that UK CPI data we got earlier today. You had a return to the 2% BOE target at the headline level, but a hot services number. So perhaps that means that the Bank of England is going to cut more slowly. Traders pairing their bets to 30% of an August cut, and that compares to 45% before this print. You've got the pound trading at $1.27, 0.2% higher, kind of reflecting that narrative, and Brent at $85 a barrel. But let's get back to the inflation story. We can bring in Jennifer McEwen, who's Capital Economics Chief Global Economist. And you've had not just this UK CPI print, but lots of ECB speak to digest as well. So, Jennifer, just give us your analysis on the inflation reading today. Does it buoy the case for BOE rate cuts, or are you worried about that hot services print?
Yeah, I think initially probably more concerned but by the hot services print as we're seeing in the market reaction, as you've said. Services inflation still at 5.7%. That's clearly much too high for the Bank of England. So while that headline rate has come down to target, that's a really scant consolation. A lot of that, of course, is about energy prices. We knew that surge would be temporary. What the Bank of England's really looking for now is for that services inflation to come down. And for that to happen, it's going to need wage growth to come down. Now, we do think that will happen. And actually, a lot of the forward-looking indicators of the labour market and the higher frequency wage growth numbers are showing that is starting to happen. But I really don't think the Bank of England can cut at the moment. We're hoping it will be able to do so by August.
Of course, you are yourself a former Bank of England economist, and they've tried to extract themselves from the political narrative. because, of course, we've had this snap election going on as well. No Monetary Policy Committee members speaking during the campaign. Do you think that they can pull off making tomorrow a non-event?
Yes, I think they probably can. It's kind of at the margin. It's slightly awkward to start cutting rates just ahead of an election. So if things were very, very finely balanced at the moment between decision to cut or not, the fact that there's an election coming up might be enough to stay the Bank of England's hand to avoid any accusations, unfair though there might be, of political meddling. And as it stands, the inflation data are still too hot, really. So everything points in the same direction. And it may be that by August, the bank's got a little bit more information about who will be governing and what their policies might be to help it in its decisions.
Well, on that, we've got the manifestos. When you look at the offerings of the major parties, is anyone showing any real ambition policy-wise?
Well, there's a lot of similarity, isn't there, between the two key contenders, the Labour Party and the Conservatives, and nobody is proposing a huge unfunded fiscal stimulus. So we've really been bitten by that in the UK following the Truss mini budget. So it's unlikely that there's going to be a really big stimulus that would either really reinvigorate the economy or prevent the Bank of England from cutting rates because it's stoking inflation. So little to be seen in that respect. More kind of redistributive type policies from the Labour government, as you would anticipate.
Now, as UK correspondent, I don't usually say what I'm about to say, Jennifer, but it does look like the SNB meeting might be a bit more exciting than the Bank of England tomorrow. It's kind of on a knife edge. What's your take of what's going to happen?
Yeah, we think it's unlikely now, actually, that the SNB will cut rates again this year. Of course, the starting point for interest rates is much lower than we're looking at in the UK, so there's maybe less urgency to bring policy rates down. And I think there's really not been enough evidence in the Swiss inflation data to cause the SNB to cut again at this stage. But it is finely balanced.
And what's your sense of the relationship between the ECB and the Fed now? Do you think on some level the ECB is waiting for the Fed to catch up with it?
No, I think President Lagarde's been very clear that ECB policy isn't driven by the Fed, and it really doesn't need to be. It's not as if the Eurozone is an emerging market where currency fluctuations are really crucial and worrying. So the ECB will continue to respond to its own domestic situation. But that said, I think whereas the inflation picture had been looking quite a lot better in the Eurozone, and of course the Eurozone had been in and out of recession, so the economy was pretty weak. Now what we're seeing is the economy starting to pick up. We've had 0.3% growth, not fantastic, but positive at least in the first quarter. And also services inflation is really looking quite sticky in the Eurozone too. So I don't think the ECB is going to be in a major hurry to cut again, and we're looking for the next one to come in September.
And part of the reason I see you note for that stickiness in Eurozone services inflation is Taylor Swift. First of all, are you a Swiftie? And secondly, can the ECB shake it off, Jennifer?
My daughter's a massive Swiftie, so I do hear a lot of Taylor Swift. I'm maybe too old. Yeah, it was partly down to her concerts, the impact that's had on inflation in, I think, Spain and Italy in particular. So there's a temporary effect there, which the ECB can shake off or look through for a while. There is also a temporary effect from a base effect regarding a drop in German public transport fares a year ago. So a couple of different temporary things there. And I think what the ECB is going to be really interested in is the fact that forward-looking wage indicators, such as there's an Indeed wage tracker, which is a relatively timely one, suggests that wage growth is going to continue to slow, even though the recent data have been a little bit worrying. So there's certainly some cause for hope in the Eurozone, and some cause to expect rates to come down further, but I think not immediately.
Jennifer McEwen, Capital Economics Chief Global Economist, never too old for Taylor Swift. We thank you, as always. Now, I promised you another exclusive interview, and it comes back to the UK general election. We're just 2 weeks away from Britain's heading to the polls. British Prime Minister Rishi Sunak and his Tory party on track to lose 2/3 of the seats they won at the last general election. That's according to the latest Ipsos poll. But the billionaire Jim Ratcliffe says the public is eager for change. Take a listen.
You've got immigration, which is one issue, and the other issue is the economic issue. If you just look at the economic issue for the UK, it's really, in my view, it's quite simple. Is the UK economy is £2 trillion. The GDP is £2 trillion, and the government take half of it, at least half of it. So the government spend is £1 trillion. Right? So, in my view, they're major. And if you look at INEOS, we spend 60 or 70 billion a year, something like that. The government spends 1 trillion. That's an awful lot more than us. So you need to spend the money well, because you're not spending your own money. You're spending the population of the UK's money. And you know, there are good reasons why people pay taxes. You've got, you know, healthcare, you've got police, you've got roads, all those types of things. And I don't think the government manages those things very well, and I don't think it focuses on them very well, and I don't think it's got the right quality people running them. But they're spending £1 trillion. You know, the health service is a mess. We don't have security anymore. Education's a bit of a mess. You know, we can't run sewage systems in the UK. I mean, you know, we had sewage systems running in the Victorian era, and you know, we allow all the utilities. I mean, just take that as a simple example. We allow all the water utilities to be sold off. They were mainly bought by French companies. Then the French companies pay £50 billion in dividends, but don't reinvest in the equipment to ensure that we've got top-class equipment to manage our, you know, sewage and drinking water facilities. And then all of a sudden it's a crisis. I mean, why doesn't the government say, if you want to buy our water utility, then these are the minimum requirements you need to, you know, and if the people don't behave, then do what they do in America, they lock them up. You know, there's some consequence if you misbehave. So you've got that whole issue of the economy, and then you've got immigration, and they haven't dealt with immigration. They've sort of danced around, but I think we had 500,000 people come in the UK last year. Well, 500,000 people is 2 times the size of Southampton. I mean, 2 Southamptons in a year, and you think about all the infrastructure. One of the basic problems we've got in here, because we've allowed so many people into the country, and that will go on forever, because, you know, we speak English in England, and all the planet speaks English now, and there are 8 billion people in the planet. There are going to be 10 billion people by 2050, so there's always going to be a flood of people trying to get into the UK, so they need to be able to deal with it. But we probably have got, you know, an infrastructure for 50 or 55 million people, and we've got 68 million people. So the hospitals don't work, the roads don't work, nothing works. And, you know, at the end of the day, somebody has to say, no, you can't, you know, we can't take any more people in. Because if you bring 500,000 people in a year, how many schools do you have to build? How many roads do you have to build? How many sewage systems? How many police stations? And we're not doing that. We're just sort of cramming them all in on the existing infrastructure, and it doesn't work.
How do you think Labour will deal with that? Do you think, you know, Sir Keir will be a good Prime Minister?
Well, I think he's a very sensible man, and he's an intelligent man. So I don't know. I think you probably have to do some unpopular things to be able to get those types of issues dealt with. It's like at Manchester United. I'm having to do some things which are unpopular, but I mean, I'm happy to do it in a political environment in a way. You know, it's a bit. I mean, I think at the end of the day, doing difficult things and, you know, a degree of unpopularity in a funny sort of way might make you more popular, because somebody's seeing that you're standing up and making some difficult decisions rather than just sort of blowing with the wind a bit. I don't know. I mean, time will tell. I can't predict how that will all go.
Run the country like you run a football club, says INEOS chairman and founder Jim Ratcliffe. He was speaking, of course, to Bloomberg's Francine Lacroix. Coming up, the 2024 presidential election is fast approaching, and we're going to hear from the former US House Speaker Paul Ryan on why he believes the race between President Biden and Donald Trump is currently too close to call. That's next. This is Bloomberg.
names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So with the 2024 presidential race heating up, former US House Speaker Paul Ryan spoke exclusively with Bloomberg's Francine Lacroix about his top strategies for navigating this unpredictable election season.
We're basically advising our clients who see a lot of unpredictability on the horizon, and they're trying to scenario plan for which way various governments are going to go. It's a little easier to predict here, I think, than it is in my country, which is a razor-thin polling and election. And it's just hard to determine who's going to win the election. Therefore, you have to scenario plan on two different potential administrations.
So can you talk us about those scenarios? I mean, is it impossible to know who will win come November now?
Yeah, I think it's just too close to call. If you really want to look at it, if this thing is tied in polling going into the election, which is probably the likeliest of scenarios, because right now Trump is polling at peak, Biden is polling below his peak performance. Let's just assume Democrats come home at the end of the day, as they typically do. It's probably going to be a few 100,000 voters in about 5 or 6 states that will determine the outcome of this election. My state of Wisconsin is one of those. Trump won it by 25,000 votes out of 1.61 million cast in 2016, and then he lost it to Biden by 20,000 votes. It's just that close.
And this is what campaigning, what makes a difference? Is it, you know, the candidates showing up, or is it big policies on the
turnout,
economy?
Campaigning, candidates showing up, the ground game, as we describe it, and getting your turnout organization going. But really, at the end of the day, it comes down to the new swing voter in America, which is a suburban, college-educated swing voter. And let's go back to Wisconsin, for example. Out of 1.61 million cast, 53,000 Wisconsinites, that's what we call ourselves, in the suburban part of Wisconsin, didn't vote for Trump, but voted for every other Republican on the ballot. And then 20,000 of those 53,000 voted for Biden, giving him the 20,000 margin of victory that he got. It's just that close. There's probably going to be Arizona, Nevada, Wisconsin, Michigan, Georgia, Pennsylvania.
So too close to call. What happens if Donald Trump is in the White House?
Right. So
the economy.
On tax policy, personally, I think it will be much better, and a lot of executives see it that way, because you have to remember that our tax law that we wrote in 2017, the individual side of that tax code has many expiring provisions, some of which hit small and medium-sized businesses, and then we have some corporate provisions like research and development tax credit, expensing provisions. Those are all up for grabs. The next presidency will help determine what happens there. So, Trump's going to be more pro-business on taxes. Biden is proposing to get rid of those things. And then it comes to tariffs. Trump's proposing a lot of tariff increases. Biden hasn't reduced the Trump tariffs. He's continued those tariffs, but I don't think he's proposing a whole new range of tariffs with respect to everything but China. On China, you basically have a bipartisan consensus.
So you've called Donald Trump unfit for office. Are you surprised at the amount of money of Wall Street titans behind Trump?
No, because I think it's too close to call, and I think people are basically trying to hedge their bets and decide. They don't know who's going to win the White House. So I think they want to basically make sure that they understand which direction the country's going to go and which administration, which they do not know will take place. That's what we basically help our clients at Teneo do, which is, what's trade going to look like under this administration? What are regulations going to look like? What's mergers and acquisitions and antitrust going to look like, et cetera, et cetera, et cetera. And right now, it's just too tight to see, so you have to plan for both contingencies.
Okay, how often do you get asked about budgets and the debt?
Yeah, that's my hobby horse. That's my biggest. That's what I used to do in Congress. Fiscal policy is my thing. I'm very concerned about this. The reason one of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. And so we have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. And so no one's proposing to solve that. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America. And it's not inconceivable to have a Treasury auction failure in a short period of time.
So what's a short period of time? Like in the next 6 months, 12 months?
No,
is it a big credit event?
It would probably be after we're done cutting interest rates. So if you're going into an interest rate cutting environment, you're going to be able to sell your bonds. Jay Powell just said he's going to do only one rate cut this year. Let's just assume it's in December. And then a number of rate cuts if all things work according to plan in 2025. So the question is, let's just assume, say, 2026, it's really hard to put a finger on these things. Do we have clarity in our fiscal policy? Have we done what we need to do to get our balance sheet in a good place? And right now, both of our candidates for president aren't proposing to do a single thing about it. I think the only shot we have, given that political reality, is perhaps an entitlement commission, but one with teeth that requires Congress to vote on it. I served on Bull Simpson the last time we had one of these things, and it could be ignored by the president and Congress, and it was. So you have to have an entitlement commission that says Congress is going to have to vote on this, up or down, no filibuster, no amendments. Yeah. And then hopefully you have a president that's willing to accept its results, if provided they're substantial. And that's, in my opinion, the best way we get out of, short of Congress actually doing its job and fixing this problem, that's the way we get out of the ditch.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
An important milestone reached, NVIDIA overtaking Apple as the world's most valuable company at over $3 trillion, which gives us a chance to look back on its meteoric rise to becoming the best performing stock of the past quarter century. And Henry Wren is here to talk us through it. Henry, good to have you with me. When it comes down to it, what ultimately paved the way for NVIDIA to climb to the top?
Yes, indeed. So it's definitely not a straight line increase, as you can imagine, but speaking of a company that was listed on NASDAQ 25 years ago, it would be very hard to imagine that the stock would, in the end, rise by 591,000% to become world's biggest company. It used to be just a company that's known for its niche chips for enthusiasts, computer gamers now, but now these days it generates most of its revenue from data center AI business. Its chips are, people just can't get enough of its chips for running all those sorts of AI algorithms, not to mention if it's Llama, it's ChatGPT, or those ones run by Chinese tech companies. And of course, gaming is still an important part of the business, but remember, the data center AI business has increased revenue by about 15 times since 2020, and compared with gaming revenue, which just increased by twice, basically, compared with 4 years ago.
Yeah, meteoric really is the only word for it. And meanwhile, it's not just NVIDIA hitting an important milestone. You've got TSMC inching towards its own milestone as well. This, of course, being an NVIDIA supplier. $1 trillion is the milestone that they're looking at. How much of NVIDIA's success comes down to its supply chain?
Yeah, it's basically supply chain is benefiting from NVIDIA, but also NVIDIA is benefiting the supply chain as well, as vice versa. So for TSMC is an important chip manufacturer for NVIDIA chips. TSMC is one of the three most major chip makers around the world based in Taiwan. And, it counts on Apple as its biggest client for most of the last decade, but now these days, NVIDIA is one of its biggest clients as well. And not to mention that as well, in Europe, we have ASML, and ASML supplies chip-making equipment for TSMC. And in the Netherlands, it has been rising 40% in terms of share price as well.
Eye-watering stuff. Bloomberg's Henry Wren, we thank you for that. That news kind of digested by markets, now looking for the next catalyst. The Stock 600 lower 0.1%. We'll have plenty more for you next, so stay with us. This is Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the Quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London. Let's check in on these markets. We've got red across a lot of the screen for European equities this afternoon, really looking for a catalyst, it has to be said. The DAX in Frankfurt lower 0.25%, the CAC 40 lower 0.7%, the FTSE managing to eke out some gains, but the Stock 600 lower 0.1%. This is because traders have kind of digested the news that Nvidia's overtaken Apple as the world's most valuable company, and now they want some more inspiration. So if we break it down by sector across Europe, take a look at this. You've got about half in positive territory. Basic resources leading the gains. They're higher 0.6%. But bottom of the basket, you've got tech, you've got real estate, the laggards today. It is the Juneteenth holiday stateside, so it means that markets are closed. Cash treasuries offline as well. But as we look to the Wall Street Open tomorrow, futures are pointing to a higher opening stateside. And if we flip over again to the European bond space, you've got yields edging higher across the curve, across the continent. But I would just draw out the 2-year yield. Currently for gilts, higher 5 basis points at 4.1%. And this is off the back of the latest UK CPI print. We're going to discuss that in just a moment with Bloomberg's Tom Rees. The pound trading at $1.27, 0.2% stronger, and Brent at $85 a barrel. But up next, we're going to speak to Janet Mui, Head of Market Analysis at RBC Brewin Dolphin. Good to have you with me, Janet, because we've got so much data to digest. I wonder what you've been making of it. All of these numbers coming out on the US economy recently. Do you believe that we're only going to have one cut from the Fed before the year is out?
Hi, Lizzie. Thanks for having me. I think one cut is about right. I think recently the U.S. data has been on the softer side. If you look at the U.S. economic surprise index, it had actually been going into a negative direction. So I do think that the Fed is leaning to a rate cut. They need to see more evidence of that. I think incrementally we are getting that evidence with a slowing inflation and also I think some mixed picture on the U.S. labor market and the latest set of weak retail sales. I think, you know, we're moving in that rate cut direction. Just not there yet, but I think getting close.
So what about the speculation of a bond rally?
Well, I think that could be a bit harder to come by. I think, first of all, the markets already expect about 2 rate cuts by the end of this year for the U.S. So I think even if we get there, that probably would not be a bond rally. I think there are lots of things to be concerned about. I think the yield curve is very inverted. I think if you go for longer maturities, I think the scope for that bond rally is just less. And I think over the longer term, you need to worry about things like the budget deficit, the rising debt, things like that. I think you know, we think there is a place for bonds because it can act as a hedge if there's economic weakness, but we just don't see a significant rally in bonds in the coming months or so.
And Janet, just turning to equities, I've spent the last couple of weeks at London Tech Week and then Cannes Lions, and both the tech sector and the marketing sector really hyping up AI. From the market's perspective, is it overblown?
I think there is certainly a lot of excitement and enthusiasm as you can see how strong the semiconductor sector or, you know, companies exposed to AI have done. But I do think that there is a lot of fundamentals that support the excitement or the rally so far. I think you can look at the order books of these semiconductor-related companies, all very strong, and you get that visibility going into 2025 as well. So, and I think, a lot of these companies, they have very high barriers to entry. So it means that they are in a good position to protect their profit margins. So I do think that this is not just based on hype, but it is based on fundamentals. But obviously, I think in the short term, the rally has gone on very, very strong, and it looks a bit stretched in the near term.
But how much further can we actually go when it comes to the chip stocks? We were just talking about the meteoric rise of NVIDIA and TSMC as well. How much more of this exponential rise can we see?
Well, from our analysis, I think there is further to go. I'm not talking about specific stocks. We're talking about the leaders in the semiconductor sector across the entire supply chain. So you got designers for chips, you got the equipment maker, you got the foundries, you got companies in the memory space and software and all these networking and things like that. So I think there is still scope for the wider sector to participate in the rally. And we have our own in-house indicator for the cyclical aspects for the semiconductor industry, and it's still flashing green, which indicates there should still be further gains in at least 6 to 12 months ahead.
So you're optimistic about tech, you're optimistic about the US. Why not the UK? Why not buy it while it's cheap?
So you raise a very good point. Actually, we have moved a little bit more overweight on the UK, actually. So in terms of the regional allocation, our favorite sector, our region is US and the semiconductor sector. But equally, we also want to have some hedge just in case there is an inflationary slowdown. I think the UK market, the setup, high exposure to the energy sector, to industrial miners and things like that, it tends to act as a hedge, in our opinion. Of course, you mentioned it is very cheap. I think the valuation is half of that, the US market. I think this is starting to get attractive. So we just increased it a little bit, I think last month.
Okay, Janet Murray, Head of Market Analysis at RBC Brewin Dolphin, we thank you. Lovely to have you back on the programme. And I want to continue this theme of UK inflation because we had new data this morning showing it falling back to the Bank of England's 2% target, finally, for the first time in almost 3 years. So it keeps the central bank on track to cut interest rates. But does the hot services number mean that the cuts are going to come more slowly? Well, Bloomberg's Tom Rees has been following the data and the market reaction. Tom, this seems like good news for the Prime Minister as well, but is it too little too late?
Yeah, absolutely. Sunak used this as a good excuse to declare victory again on inflation. He's declared it a few times, but he can always say it more. But yeah, you're right. The issue is that although the headline rate is down at 2%, first time it's been there since July 2021, it's those underlying measures that are not really behaving the way the Bank of England would like, and therefore any hope of, there was no hope of a rate cut tomorrow's decision because of the campaign, but
is it just because of the campaign, or is it also because of the data?
No, what was interesting is that the election was announced just hours after the last inflation release, and we actually saw the repricing on markets actually happen after the inflation release that morning. So markets were already moving to kind of move back rate cut expectations to further later in the year. But the election campaign, let's be honest, just completely ended it.
And what's also interesting about this meeting tomorrow is it's the last one for Deputy Governor Ben Broadbent before he's replaced by Claire Lombardelli. I just wonder what we're thinking about how her addition is going to change up the dynamic on the committee.
Yeah, it's interesting. Economists kind of thought that Ben Broadbent would want to leave on a kind of a final hurrah, he'd be able to cut rates and say that I defeated inflation before I left the bank, because let's remember he's been there for like 13, 14 years. But the addition of Claire Lombardelli, it's interesting. We haven't heard loads from her, but what we have heard has sounded slightly more hawkish. So it'll be interesting to see where she sort of fits on the MPC, because Broadbent was very much kind of the intellectual underpinnings behind behind the scenes, really driving policy at the bank. We'll see whether Claire Lombardelli does that and whether it pushes the bank in a kind of more hawkish direction.
Yeah, and slows the cuts down at the Bank of England. And so is there anything in tomorrow's decision that we should be looking out as markets for a surprise? Anything that could change the pricing, perhaps?
Yeah, it's slightly finger all on that. So we'll probably get the same vote split. We'll probably get the same guidance. But one thing to look out for is how the Bank of England is reacting to the last couple of rounds of data, because during this election campaign, the Bank of England has not been able to speak publicly. It's kind of part of the way things are in the UK, that the Bank of England keeps quiet during these election periods. And so this will be the first opportunity that we've had to see whether the Bank of England's been quite relaxed about some of the overshoots that we've been getting in services inflation, and whether that means that maybe they look at cutting in August or September.
Because, of course, some people are warning that you could have a rise in inflation towards the end of the year. Not the best inheritance for Rachel Reeves if she's the first female chancellor.
No, absolutely. Yeah, everyone sort of expects a bit of a pickup, largely due to kind of base effects, as you know, the annual calculations, some drop out, some come back in. So there's that effect going on. But I think what really concerns the bank is whether the current kind of levels of service inflation, wage growth, how that plays into future inflation, whether that means their expectations on headline inflation are a little bit lower than below where they should be.
Yeah, because of course that's the bit that they can actually control.
Absolutely,
Same story for Christine Lagarde over at the ECB. Well, Tom Rees, I'm sure you'll be very busy tomorrow with that Bank of England decision. Thank you for the preview. And coming up on the programme, we're going to go to crypto markets. Ether surging on a report that the SEC is winding down an investigation into the token status as a commodity. We'll have analysis of that for you next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
So Golden Goose has postponed its IPO. The luxury sneaker maker, backed by the private equity firm Permira, have taken the decision to shelve the listing for now. And here to tell us why is Bloomberg's Sweta Gopinath. Sweta, just talk to us about what's behind this postponement. Is it a Golden Goose thing or is it a luxury thing?
It's a bit of both, honestly. Luxury stocks have come off a lot in the past couple of weeks since Golden Goose launched their ITF, their intention to float. And their closest competitors, their closest peers in the market have come off a lot. And there is also sort of a broader uncertainty about European markets right now following snap elections in France. There's been sort of a broad sell-off, right? So there was enough demand, we're being told, for the shares that were being offered in the IPO. But Permira, which is a backer, was worried about first-day performance, how the stock would trade post-listing, and that was behind the decision to pull the IPO, essentially.
I'm kind of wondering whether it's not just a luxury thing or a European equities thing, or maybe it's just a shoe thing. Because, you know, Dr. Martens had its listing, which was kind of a flop.
Which was also a Permira asset, actually. So they were very keen to avoid another sort of IPO debacle, if I may say so. They didn't want another poor IPO performance. So they've decided to hold off for now and try the market at another time.
Yeah, they don't want to put the boot in their reputation, as you might say. But just talk to us about how the political risk feeds through then into a decision like this. Is it that maybe after the elections they'll reconsider the IPO?
It's unclear when they'll come back to market, and it's going to be a bit tricky as well because they've now set a price. There's a price marker. So the next time they try, it's not like they can come back at a higher valuation. Investors know exactly what the stock is worth. They'll also have to be confident of getting that first-day pop that they want, of solid first-day trading that they're seeking. So we really have to see how markets pan out in the coming months. It's going to be pretty quiet now until after the summer, it looks like, for the European IPO market.
Oh, you say that. That's what makes things get busy and exciting.
Hopefully, we do want more IPOs in Europe, for sure.
So to go for now, thank you for that analysis of the Golden Goose IPO, or not, put on the shelf for now. And now let's turn to crypto, because we've got Ether climbing amid the speculation that the SEC probe on the digital asset may actually be easing. So in a posting on X, Consensus, which is a developer of Ethereum, said, quote, "The enforcement division of the SEC has notified us that it is closing its investigation into Ethereum 2.0. Now, this comes amid a possible approval of an Ether ETF in the US. And to break it all down for us is Bloomberg's Emily Nicole. And you're all across this, Emily, so I'm glad you can explain it for us. What's the speculation actually based on that this regulation is going to get eased?
So Consensus say they received a letter from the SEC in response to some litigation that's been going on between the two of them, saying that they've concluded the investigation into the matter and that there won't be any enforcement action happening as a result of that investigation against Consensus. What we haven't heard, though, is from the SEC to kind of confirm it on their end. So at the moment, you know, it's not officially ended, but it is a nice little boost to the market, you know, thinking that perhaps the worst is behind Ethereum, and we might look forward to Ethereum ETFs being approved in the near future.
And just for anyone who's not really familiar with the crypto regulation, it basically comes down to whether Bitcoin is a security or commodity, right?
Yes, so Bitcoin has kind of been already decided likely not a security. That's why they were able to have the Bitcoin ETFs launched in January. And Gary Gensler, as SEC chair, he's always kind of said he didn't think Bitcoin fell into that bracket. Ethereum, however, he's never been sure. He's never said, you know, we think this is a security, we think this might be a commodity. There's always the chance that it could be ruled as a security. And Ethereum, because like Ether is the token that runs on the Ethereum blockchain, but the Ethereum blockchain itself is the home for many cryptocurrencies all across the spectrum. All of the altcoins, a lot of the meme coins that everyone's trading at the minute, these are all on Ethereum. And so if it is decided that Ether is a security, that could spell trouble as well for a lot of the other coins in the system that people like to buy.
I mean, let me go out on a limb and ask you the 101 question. What's the difference? Why would they be classed differently?
I mean, so at the core, I mean, there's difference in terms of how you would apply the Howey test, right? If something is a security or not a security, ultimately what it does is determine which regulator would oversee those assets, if you're overseen by the SEC or if you're overseen by the CFTC. And now both of those regulators think they should be in charge of crypto. If you look at filings that have come out from both regulators, they both say, we think this is a security, we think this is a commodity, and that's why we have the bandwidth we have. It's what has formed the basis of a lot of the SEC's actions against companies like Coinbase and Kraken, thinking that they have that authority over them. But it's not definitive yet. We haven't really seen it laid down. And if Ether is found to be a commodity, for example, that'll make the crypto industry quite happy because it's a different kind of regulation, one they're much more familiar with, one that's much less restrictive, and therefore, you know, much better for the industry.
And of course, Ethereum, as you say, Ethereum blockchain is the most important for crypto-based financial services. What's the outlook for sentiment ahead then? You've got also Bitcoin sentiment falling. It's at a 1-month low. How do we bring it all together?
Well, Bitcoin itself is kind of operating in a bit of a vacuum at the minute. You know, we've always said over the last few years, Bitcoin is quite heavily correlated with tech stocks. It kind of trades in the same window. Last year, it actually broke out of that to perform much better. Bitcoin was one of the top performing assets of the year compared to things that are kind of traditionally in the markets that you would bet on as a risk asset. This time around, it's doing much worse. So if you've got the big rises in the S&P 500, we're not seeing that happen in Bitcoin. And that's potentially because of the ETFs being launched in January. A lot of people were able to pile into it in a big rush, big wave in January and February, and since then, you know, demand has tapered off. Those funds don't see as many inflows as we used to, and so it's kind of operating on its own. Whereas Ether and what happens with that, it dictates a lot of what happens with the smaller cryptocurrencies that people like to bet on, where you can get those bigger swings, more chance for reward, more chance of a loss, and so that's why people are watching this one very closely as well.
Emily, I could listen to you explain crypto to me all day long, but we've only got time for that much. Thank you again. That's Bloomberg's Emily Nicol. Coming up on the programme, we're going to bring you our interview with the Citroën CEO, Thierry Koskas. That's coming up next. This is Bloomberg.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A slowdown in demand for electric vehicles, plus new tariffs on imports from China, has put the focus on pricing for automakers. Today, Stellantis announcing a new electric SUV that, for now, is the least expensive EV made in Europe. Citroën brand CEO Thierry Koskas sat down with Bloomberg's Francine Lacroix and shared what he sees in store for the coming months.
I think that the market remains fairly strong. It's progressing year on year. So we are very confident that the market conditions will be favorable in the months to come. It's very much a question of being able to offer the cars that the customer needs, particularly electric vehicle. You know that we are selling more and more electric cars. We need to be able to offer affordable electric cars, and that's what we are doing with the new C3 Aircross.
So talk to me a little bit about, in general, you know, the slowdown has been more pronounced for EV cars. And again, this varies from country to country. This may be because some of the incentives have been removed. How do you see demand for EVs in general? And also, how do you see demand for the new C3?
Well, actually, yes, I understand that there is a slowdown in some countries, but we shall not forget that anyway, we have to grow the share of electric sales. Just to give you a very concrete example, in 2025, we will have, like any other manufacturer, to double the share of electric cars in our sales. This is the short-term objectives that we have to face. So at the end of the day, we have to sell electric cars, and we have to sell electric cars profitably, which means we need to be able to offer products that the customers want. And when we look at the new EC3 we revealed a few months ago, first European electric car below 25,000 euros. Now today, the new EC3 Aircross, electric SUV below 30,000 euros. We are coming with very attractive offers, and we think that it will enable to grow the electric car sales for Citroën.
But do you worry about pricing? Or are you very sensitive to that, especially depending on the kind of market or the country you're in?
Well, obviously, pricing for electric cars, it's a big challenge. So we have to overcome that with, first of all, very competitive offers. That's what we have today. Today, you do not find an electric SUV below 30,000 euros. We are introducing that in the market. But also, what I would like to highlight is it's not only a question of price, okay? It's going down, it's great, but it's also a question of usage cost. If you use, for example, a C3 Aircross electric compared to a petrol version, you will probably save up to 1,000 euros per year. So it's absolutely significant, which means, yes, the selling price may be higher. You can finance the car, obviously, but then in terms of usage cost, the customers will enjoy a much more favorable usage cost. That's very important to take into account.
Yeah, but if it's not translating into consumer demand, then it's quite tricky. I mean, the other big thing is, you know, the incoming additional EU tariffs on Chinese EV imports. Are you expecting that to give a big boost to the EV market in Europe?
Well, obviously, the Chinese offensive is there. The Chinese competitors are coming, and they are challenging us because they are coming with very competitive offers. So what we need to do is to fight with the same weapons and to be able to produce cars at a competitive cost versus the Chinese. This is what we are doing with C3 and C3 Aircross. We think we have very competitive cost base for a car made in Europe that will enable us to face the Chinese competition and participate to the growth of the electric market in Europe.
The Citroën CEO there. And coming up next, I'm going to be joined by Zachary Hill of Horizon Investments. We'll continue our markets conversation. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience.